when they themselves don't feel comfortable in the data. And really just look at the change in the set, the change in the dots, the expectations over the course of the last year. You see how unsure they are in terms of the economy evolving and how hard it is for the data to interpret. They still don't have a handle on that. And until they do, it's going to be hard for investors to get real comfortable that they can control inflation, that they can control a lot of the animal spirits that drive the long end of the market.
Well, Marvin, when you talk about that uncertainty, well, really isn't that just Donald Trump? You write in your note, the incoming administration will have an outsized impact on market outlook and will be given the benefit of the doubt during the first 100 days. What are you expecting from the Trump administration those first 100 days?
Yeah, I mean, for sure, it's the uncertainty created by this administration. Its policies are something that are, not the normal course of economic models and the economy. I think what we're going to do is get a sense of how they're going to approach fiscal more in the first 100 days. I think 2025 is focused on the budget. It's focused on kind of either making permanent or resuspending a lot of the tax increases that would have come. That would have sunsetted normally, and then just really kind of debt ceiling, as we saw, they really weren't able to get a handle on that. I think that in terms of where yields are going to go, that first 100 days will set what the fiscal approach is going to be, and that's really what's driving a lot of the concern around the bond markets at this point.
What are you expecting in terms of sequencing, though? So you mentioned some fiscal spending that's likely going to be a tax bill, but that's going to be very challenging to get done almost immediately.
Yep. Yep, for sure. So tariff policy. Just, whether or not tariffs are a means to an end or the end themselves. What we saw during the first administration, the first time the Trump administration sat in these seats, was that they used tariffs as effectively a bully pulpit, a way to get other things that it wanted. If they take that same approach, tariffs probably are not as inflationary as kind of the worst case, where if it's a blanket tariff across the entire world and we're talking somewhere around 15 to 20%, the pass-through from an inflation perspective is much more direct and likely much quicker. If we do wind up seeing a little bit of deal making as part of that process, I think that retailers will pass through. I think there is an inflationary impulse, but the long-term impact of it becomes much clearer in terms of it not being something that we need to build into our models permanently, if you will.
Marvin, how much about next year is in general just about being nimble? When you're thinking, how do I set up my portfolio to end the year? What sort of window dressing do I want to do? What does a 2025 portfolio look like? Is it one of just sticking to certain philosophies, to certain positions and convictions you have? Or is this a year where you can't really have convictions?
I think that entering a market like this without convictions is ultimately dangerous. It certainly depends if you're, a very aggressive trader, if you're kind of looking at a hedge fund model where you're looking to leverage. From that perspective, you have to be quite nimble. But broadly speaking, from a more traditional investor asset allocation perspective, you need some conviction. You need the conviction either in U.S. stocks, or you need the conviction in terms of globalization, or you need the conviction of asset allocation in general in terms of what your percentage of fixed income is, which is quite low in this market at this point. I think you need that to really anchor you, because we're going to have a lot of volatility. For me, U.S. exceptionalism still works. I think the market concentration that worries a lot of people is there for a reason. These are companies that ultimately have performed, and investors are always willing to pay for growth. And really, this fixed income underweight becomes one of the bigger questions. How much credit, how much sovereign debt, how much interest rate exposure do you want in this market? And that, I think, is probably the most fluid part of the discussion for me.
Marvin, thank you so much for spending some of your holiday week
you.
with Danny and myself this morning. Marvin Lowe of State Street, and happy New Year to you as well. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Good morning, Anne-Marie and Danny in London. The Bank of Japan is signaling a rate hike is still possible next month, despite a cautious decision at a recent policy meeting. According to a summary of its December meeting released today, board members expressed both pro-rate hike and wait-and-see views. Factors they're considering include wage trends and the trajectory of the U.S. economy under President-elect Donald Trump. 2024 was a year to forget for France's wealthiest. LVMH CEO Bernard Arnault, L'Oreal heiress Francois Meyer, and Kering CEO Francois Pinault saw about $70 billion erased from their collective wealth this year. This due to weak demand for luxury goods and a pullback by Chinese consumers. Still, some investors are optimistic about the sector, citing the expansion of the middle class in emerging markets and increasing demand for high-end products. And Kim Kardashian is no longer assisting in managing SKKY Partners, the private equity firm she co-founded in 2022. In a securities filing this week, the firm disclosed that the Kardashian is no longer an executive officer. Its website now refers to her as a co-founder and senior operating advisor. She was previously listed as a managing partner. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. We'll have more from Yahira as well, an update in about 30 minutes' time. Up next in the program, next year's airline outlook.
We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. There's still strength there and still some dry powder.
That's coming up next. You're watching Bloomberg Surveillance.
To the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Good morning from London on this holiday shortened week. Your equity markets this morning stacking up like this. It is another weaker session, a second consecutive, led lower by tech in a year that's been very tech heavy. 6,000 above that is where your S&P 500 futures sit. Little change on the euro versus the dollar at 104. Your 10-year yield, that coming under pressure, up 3 basis points despite strong demand for duration yesterday. A very solid 7-year auction. Volumes light across the board, 4.61% on your 10-year yield. NYMEX crude, that sets at $70 a barrel, higher by just under 1%. Under surveillance this morning, next year's airline outlook.
We're seeing an uptick in lodging, travel, experiences, which is also what we see in our consumer data. So people are spending on, memories. How do they take trips? We continue to see strength in the consumer in all cohorts. And, they are spending, and we've seen an uptick in holiday spending going into the holiday season. And so, there's still strength there and still some dry powder.
Here's the latest. 2025 will likely be a record-breaking year for the airline industry. According to the International Air Transport Association, global airlines stand to rake in more than $1 trillion, driven by a record 5.3 billion passengers taking to the skies. Savi Sith of Raymond James writes, the economy, and in particular the health of the middle and high-income household consumers, will continue to be the most important factor for the group. And Savi joins us now. Savi, is there any sign of those cohorts slowing down in their airline spend?
Hey, Danny. Yeah, it's been a strong year, and for 2024, and what we can see so far is that it's going to continue into 2025. It's been more of a mixed year by airline group, where you have a group that's making good profits and another group that's not, but that's more about internal factors than consumer demand. So the setup for 2025 from a demand perspective looks good.
I want to talk about those two groups, Savi, because on the downside, you have the airlines, as you point out, that have less of a premium offer and don't fly as many international routes. For those airlines, first of all, who are they? And what does recovery look like? Is it possible at this stage?
Yeah, it's a lot of, it's a mixed group, but you have, Southwest in there that's making a small profit this year. You have JetBlue and Spirit and Frontier also kind of making either a small profit or losing money. And so it's been a struggle. But what you've seen since the summer has been this group has really adjusted their capacity. The big difference between this group and the group that's making good money is as you pointed out, just having exposure to premium traffic and international, kind of the strong demand on the international market, but also the amount of capacity that they've added since 2019. And so this is a group that kind of kept taking aircraft during the pandemic. And so given the kind of the level of cost inflation that we've seen, that I think the supply for that group is too high relative to what needs to be passed through in terms of cost. So what you've seen since the summer is an adjustment on capacity growth, and that is making a pretty good setup here into 2025 and probably into 2026 for the group as kind of supply starts to balance back with demand.
Well, this I find so interesting, Savi, because it has really been a period of back and forth. You go through COVID, you go through shutdowns. You don't need the capacity. Then you go through revenge travel, and these airlines can't get enough and need more planes. And now, as you say, they're talking about getting back to equilibrium and maybe not needing all of that capacity. How close are we to equilibrium? You say the outlook is good, but how fragile are we at this moment that something could upset it yet again?
Yeah, I think the issue here is not demand. The issue here is how much costs have gone up. You have seen just mostly labor costs, but costs across the system, including maintenance and aircraft costs, and they've gone up and wiped out about 6 to 8 points of margin that was there in 2019. So it's not about demand. I think the desire to travel is there. It's the price point with which you want to travel. And so I think what we're seeing here is capacity getting right sized to that, to a higher level of fare that's needed to cover costs. And so I think we're getting there. And 2025 promises to be kind of a margin expansion year, especially for those airlines that have struggled. And we probably still need another year into 2026 for many of these airlines to see that recovery back to 2019 margins.
Yeah, because what we've seen this year, Savi, is people still complaining about prices. I mean, we hear it all the time of what it costs to fly internationally. And then you shortly hear that followed with, well, things are so cheap in Europe. Well, things are so cheap in Japan. The yen is so weak. How much of 2025 travel, especially internationally, is just about the strength of the dollar?
Yeah, but I think that's what you've seen in 2024 as well. It's interesting. There is a kind of a tale of two stories here, too, where international supply has actually been much more constrained than domestic U.S. supply. And so the supply issue that you've seen in domestic markets and the margins you've seen in the domestic markets have not been played out in long-haul international. Long-haul international is actually very strong. One, because supply is constrained. You had a lot of wide-body aircraft that have been retired, and the Airbus and Boeing just haven't been able to keep up with the demand to replace that the fleets that have been retired. On top of that, the U.S. point of sale particularly has been very strong. I think part of that is kind of a post-pandemic desire to travel, but also the very strong U.S. dollar. And with the strengthening that we've seen recently, I think that's going to continue here into 2025, and is a pretty decent setup for airlines, maybe not necessarily for passenger wallets.
Fair enough. And let not us forget what some of that strength is coming from. It's a new administration. So I wonder if you have two things on the side of the airlines, both the strong dollar and M&A's return. Savi, how likely is that? After we saw many attempts, many runs at it get shut down by regulators, where in this industry, what airlines could you potentially see mergers that benefit them? And again, with a more friendly administration.
Yeah, you're exactly right, Danny. You know, you did see 2 or 3 opportunities get dismissed. Alaska, Hawaiian did go through under the current administration. I think, especially given how smaller airlines are struggling, I think we'll see a much more receptiveness to see kind of mergers among, you know, the ULCC group, like a Frontier Spirit, or some of the kind of the more private airlines that you see out there. So see opportunity for that in this kind of next administration, which also, you know, puts up a pretty good setup. The other thing I would say with kind of the incoming administration is there seems to be a little bit of kind of regulatory overreach in the current administration as from an airline industry perspective, and we expect to see less of that going forward. And some of the items that are being challenged in courts today, I think will probably come in the favor of airlines as well.
Hey, Savi, before I let you go, we have to talk about some of the drama, or maybe attempted drama, lack of drama over the past few days. You had American Air very, very briefly ground some flights, which again did not last long, but still maybe ruined a couple people's holiday travel. You also had Japan Air suffering a cyber attack. In 2025, how much of it is going to be about these airlines right-sizing some of their technology and their offerings?
Yeah, airlines have been doing a lot to invest in technology. It's almost a hamster wheel, although, because you are constantly trying to keep up. But there's a lot of investment going into technology, and also, you know, a lot of airlines are moving to the cloud, which is a lot more stable than some of the kind of legacy systems. So I think we will, you know, see a lot of improvement. You'll still see kind of tech issues, but I think airlines are getting better, and the technology is getting better about kind of reacting to it. And luckily, the American, you know, tech outage was very, you know, short-lived. A lot of people got delayed, hopefully did misconnect, but at least from a, you know, cancellation point, it was very low. So they recovered very quickly.
Well, hopefully everyone who needs to go back to whatever city that they live in can do so easily after the holidays. Savi, thank you so much. Savi Sith of Raymond James. Coming up, Dan Ives of Wedbush joins on his latest Apple upgrade and his outlook for the tech sector. You're watching Bloomberg Surveillance on this Friday.
missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China show live every weekday.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning and welcome to Bloomberg Surveillance at 6:30 a.m. right here on the East Coast. It's a shortened holiday week, and you can see that reflected in the markets this morning. We do have futures this morning in the red, second straight session in the red. But of course, Danny, this comes after the S&P 500 up more than 25% this year. A lot of people are starting to calibrate what 2025 has to bring. A lot of people are talking about volatility when it comes to policy out of Washington, D.C. Dates on the horizon. January 10th, we have the Jobs Day, the 15th CPI, and then January 20th is Inauguration Day. And then the Fed meets 10 days later. And how important of what Donald Trump does, and even that first week, potentially gives signs to the FOMC on what's expected, Danny, in 2025.
As you've been saying, Anne-Marie, it is all about sequencing. And as of yet, we don't know what it is because that is still a point that's unknown. So how do you set up a portfolio when 2025 has so many bipolar outcomes? I think one of the remarkable things, and you saw it on that futures board there, Anne-Marie, is that what we thought might work already isn't. And that is something like small caps. That is something like a broadening rally. We thought under Donald Trump that would work. So far, it hasn't.
So far, it hasn't. What we have seen, though, of course, is yields rising. And we just heard from Marvin Lowe talking about how the long end, a lot of that is going to be dictated by policy. The 10-year yield this morning up 3 basis points. Danny, you said even this comes as very strong demand yesterday, Thursday of the holiday week. Strong demand when it came to that debt sale. You do have the 10-year yield now trading at 4.61%. And then the euro. We have seen the weakness in the euro throughout this entire year. We came into the year with euro dollar about 110. Right now, it's sitting at 104. Danny, you're sitting in London right now. How difficult is next year going to be for Europe? France has a new cabinet that they must pass this new budget. Germany is going to be dealing with fresh elections, and all of this as they have a fresh administration to contend with.
It is a political vacuum in Europe and around the world. And perhaps the feeling is most acute in Europe because they don't have the cohesion that they might need in order to combat this. Mario Draghi, one of the big pieces of 2024 was him unveiling this framework for Europe to come together, more investment, more bonds. Individual countries, Anne-Marie, don't even have it together. So what's the ability of Europe to really combat any potential tariffs? As of now, that outlook looks increasingly pessimistic.
Yeah, Europe is going to be a very challenging story for 2025. And that's why a lot of people are saying, look, Jeff, we might get parity when it comes to the euro dollar. Under surveillance this morning, Danny and I have some stories we're watching. South Korea's parliament impeached the acting president, Han Duck-soo, less than 2 weeks after impeaching President Yoon for his brief martial law decree. Han will suspend his duties, and the country's finance minister is now next in line to serve as interim leader. Danny, this is just yet another blow to a government already reeling from Yoon's suspension.
And we should just remind viewers of what the setup looks like now, because they've elevated the finance minister, but he doesn't stop his finance minister job. So he has to be the acting president, now the acting prime minister, because the prime minister also has been impeached, and an acting finance minister. That is nearly an impossible task for one person to do all those three. By the way, in an economy that's facing some issues, sentiment, the latest surveys are extremely low in South Korea. And Anne-Marie, this is the same problem we were just talking about in Europe. They might have more problems coming down the pike if you have Donald Trump trying to put tariffs on a country whose leaders are only acting leaders and having to fill multiple vacancies all at once.
Right, and you look at South Korea and you think actually Germany and France might not look too bad right now. Also, what we're watching this morning, the Azerbaijan Airlines plane that crashed in Kazakhstan during an attempted emergency landing on Christmas Day was damaged by Russian air defense systems. This is according to an Azerbaijan government-backed news website. 38 people were killed in the crash while 29 survived the crash. Absolutely devastating. We should note the cause of the crash still under investigation, but it really, Danny, shows the impact of the fog of war. The aircraft's communication system was paralyzed by the use of electronic warfare systems used by the Russians.
Yeah, it brings back memories of a Malaysia Air flight in 2014 that was also struck down flying over Ukraine and Russian airspace in the middle of the conflict. And Anne-Marie, I was interested in this. Who still flies over Russia? Much of the West is blocked out. Much of Europe is blocked out, not because of safety concerns, but because when sanctions were put on, Russia retaliated by closing its airspace to a lot of these companies. It's fascinating to see that you also have a lot of these airlines complaining about their lack of ability to go over Russian airspace. Air France KLM was saying basically the Chinese are beating us out because they can fly over Russia and cut their flight times down significantly and not have to pay as much in fuel. But incidents like this, I wonder how much it turns to public opinion that a lot of these Western airlines and maybe other ones will decide not to fly over these regions because of their passengers and fear that this sort of thing might happen. It's maybe not just about air fuel costs at this point.
Right, definitely, this fog of war, and we'll bring you any updates we get as that investigation is ongoing. Israel striking multiple targets in Yemen that it said were controlled by Houthis, including military infrastructure and power stations. The attack came as Houthis have been launching attacks on Israel, including ballistic missiles, but Israel has been intercepting most of them. So we have this tit for tat playing out. We also have the Houthis, Danny, really still controlling the Red Sea for much of this year. Interesting stat and a statement from Egypt yesterday. The Red Sea disruptions, of course, this has to do with the consequences of the Houthis' maritime attacks, have cost Egypt at least $7 billion in Suez Canal revenue this year. And we still continue to see this be a headache for vessels that are basically saying we can no longer go through the Red Sea and we have to find different routes to get to our destination.
It's a reminder that this is still happening, that these vessels, that these targeted attacks are still happening in the Red Sea, and a completely different setup that Israel needs to face than some of the Iranian-backed groups in its backyard, Hamas, Hezbollah, ones that they've made significant strides against. Yemen is completely different. Yemen is 1,000 miles away from Israel, and a lot of agencies, experts have said that Israel doesn't have the type of intelligence in Yemen for the Houthis that it does for these other groups. But Anne-Marie, I'm really fascinated by this idea. Wall Street Journal article yesterday saying that Israel thinks that it has the chance to really turn diplomacy in its favor in Arab countries. For those that see the Houthis as a thorn in their side, for those like Saudi Arabia that want to curb some of Iran's influence, that these types of actions by Israel help actually coalesce some of these Arab states. Of course, the issue for Israel now, though, is that public opinion, especially in the Middle East of Israel, is at an all-time low.
And also, if they can get a ceasefire hostage agreement through Gaza, we do know those talks are ongoing. All right, we're going to turn to tech now. Dan Ives of Wedbush raising his Apple price target from $300 to $325, writing, quote, "We believe Apple is heading into a multi-year AI-driven iPhone upgrade cycle that is still being underestimated by the street. Apple's on pace to reach the $4 trillion market cap threshold and be the first member of this exclusive club." I'm so excited that Dan Ives joins us now. Dan, thank you so much for spending spending part of your holiday shortened week with us here at Bloomberg. So why now? Why lifting the price target now? This awkward week between Christmas and New Year's, and you said, I have a call to make.
Yeah, because the bears, they're in hibernation mode because they can't find AI in the spreadsheets. And look, we're doing the work. What we see across the Asia supply chain, I mean, we're seeing strength not just into December, what I believe is going to be ultimately a record year for Apple, 240 million iPhone units. And that's why, look, this is going to be an AI-driven supercycle that's multi-year. And that's why, look, the haters, they hate it at $2 trillion. Despise it at $3 trillion. At $4 trillion, going to be yelling from the top of the mountains.
You write in your note that you estimate roughly 300 million iPhones globally have not upgraded in over 4 years. So do you think this upgrade cycle is going to be led out of necessity because people are just desperate for a new phone? Or is it that AI capability that Apple's starting to introduce?
I think about 60–70% of it is that you've gotten to the point now where that's a pent-up upgrade cycle. It's really unprecedented for Apple. But also remember that install base, that's increased 200 million even over the last few years. So the install base continues to be the golden goose of Cupertino. But the AI-driven piece, it's just starting. That's why it's a get out the popcorn moment, because in our opinion, the consumer AI revolution goes through Cupertino. And I think, look, that's why the bears will talk about valuation like they have for years in Apple. It's about some of the parts, about what AI adds to the story. We think it's $30 to $40 per share.
How hard would it be, though, for the next upgrade cycle, especially if so much is driven now by software updates? The hardware hasn't really changed.
Well, I think that's in iPhone 17. Again, that will be, what we'll be seeing later this year, into 2025. That's actually going to be a hardware-driven, a new form factor that's really going to be AI-driven. So that's why this is it's a 1-2 punch. It's 16 into 17, and that's why what makes this unique, it's about the increased services, and ultimately you have hundreds of apps right now in development that are going to be on top of Apple Intelligence, and that's why the enterprise AI revolution is the godfather of AI, Jensen NVIDIA. The consumer AI revolution goes through Cupertino, and I think that's why we could see $4 trillion potentially, today or Monday.
One potential difficult spot, or is a difficult spot, is China. How are you thinking about China, especially with the fact that Apple needs to partner with a local company to introduce all of this?
Sure. Look, Cook, 10% politician, 90% CEO, right? And no one understands.
He might actually have to be more of a diplomat in 2025 than 10%.
And maybe 30%, 70%. But the point is, look, it's what him and Musk have had to navigate in terms of success in China. But what I love about the cycle, that probably gets announced from the Chinese partner early in 2025. It gets rolled out in April. So the China upgrade cycle in terms of AI coming to China, that's something that happens in April. And this is just the beginning of a multi-year AI cycle that plays out from Apple.
You also talk about Palantir and Salesforce in your note. I recently spoke to Mark Benioff about Agentforce and this new iteration they introduced of Agentforce, and he said it's the most exciting thing he's worked on in his entire career. Is that why you're so excited as well about this?
And for context, Benioff, Mount Rushmore of tech, right? But it speaks to our view. It's 10 p.m. in this AI party that goes to 4 a.m. And behind the velvet ropes, Benioff wanted to see his name's on the list. Now, all of a sudden, he's on the dance floor. Software is let in. Now, already on the dance floor from a use case perspective is the Messi of AI, Palantir. And look, that's one, as I say, the bears can't see AI in the spreadsheets. That's how, they hated Palantir as a teenager earlier this year, despised as a senior citizen living in Delray Beach at 83. But it's just the beginning now of what I view as the software age in AI. Salesforce, Palantir, and I think others like MongoDB.
What names do you think we're going to be talking about next year that were very quiet during 2024? 2024 really was about NVIDIA, Tesla. What do you think will be the names of 2024?
Yeah, I think those continue to lead in terms of my view for large cap tech. I think up 25% 2025. I think what hasn't been on the radar, it's going to be M&A, software, cybersecurity, because with Khan done at the FTC, that nightmare, whether it's Nightmare on Elm Street, Friday the 13th, is done for tech. Now I think you're going to see a lot of accelerated M&A when it comes to software, when it comes to cybersecurity. And I think that That is really is what's going to lead this AI cycle. And I think specifically cybersecurity is an area that I believe could ultimately be one of the biggest outperformers when it comes to tech.
Another tech analyst joined me this week and said the same thing. 2025 is all going to be about cybersecurity. I want to end on Tesla. Overnight, Elon Musk was clashing with a far-right activist who has been close to President-elect Trump, Laura Loomer. And the crux of the argument was about H-1B visas. But this individual is also saying that Musk really isn't MAGA, and yet he's so close to President-elect Trump. Do you think there's a risk there, actually, that he will lose that proximity to power, which you said was one of the best bets of the ages?
Look, it's a bet for the ages. I think that bromance actually gets stronger between Musk and Trump, because my view is that Trump needs Musk, Musk needs Trump. And whether it's AI, whether it's China, whether it's some of the policies in terms of DOGE, we're going to have these continued dust-ups. So this is going to be a soap opera, I think, for Musk and Trump that continues to play out. But that is going to actually strengthen, and it continues to be for Musk. It's the best bet he ever made on Trump.
Okay, so this is just a flare-up in an episode, not the season finale.
Exactly. View this as just one episode in a 10 to 12-parter on Netflix.
All right, Dan Ives of Wedbush, thank you so much for joining us this Friday. We want to get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Bitcoin's rally is losing steam as traders take profits after its stellar rise this year. And there may be some volatility ahead for the cryptocurrency. According to prime broker Falcon X, a substantial quantity of Bitcoin options contracts expire today. It's one of the biggest such events in the history of digital assets. You could be Jeff Bezos' neighbor in South Florida. A plot of land next to the Amazon founder's properties in South Florida is on sale for $200 million. The property is about 1.84 acres in size and is located at Indian Creek, a private artificial island in Miami-Dade County. Called the Billionaire Bunker, the island houses properties belonging to Jared Kushner and Ivanka Trump, as well as Tom Brady and Carl Icahn. The $200 million asking price is more than what Bezos paid for any of his 3 properties on the island. And India's former Prime Minister Manmohan Singh died yesterday at the age of 92. Singh was a key figure in India's economic liberalization, serving both as finance minister and prime minister. He is also credited with opening up the economy to foreign investment and increasing its size 7-fold. Singh was respected for his simple lifestyle and commitment to education. That's your Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira. Up next in the program, next year's commodity outlook.
The commodity markets are going, no, growth isn't really very good. The commodity markets are telling you there's not an expectation that there's going to be bigger demand.
What's on the horizon in the commodity space? That's coming up next. You're watching Bloomberg Surveillance this Friday morning on Bloomberg TV.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea. But ultimately, you still have to do a lot of it. It just give you very superficial ideas, and but at the end, you still have to customize and how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I see that, when a designer doing it's the spirit, it's the heart that the computer don't have.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup.
This is a 3 as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The Santa rally has come and gone. Good morning. You're with Bloomberg Surveillance this morning to end your holiday week. It is a second consecutive day of declines for this equity market, down 1/3% for your S&P 500 futures, led lower by the Russell 2000. The euro, that strengthening versus the dollar this morning at 104, but it is yields that move higher. 10-year yield at 4.61%, up by 3 basis points, despite the fact that we had a strong 7-year auction yesterday and weaker labor data. Continuing claims at the highest in 3 years. That's still not putting demand into duration this morning. NYMEX crude, that is up nearly 1%, $70.25. Under surveillance this morning, next year's commodity outlook.
The commodity markets are going, no, growth isn't really very good. The commodity markets are telling you there's not an expectation that there's going to be bigger demand.
Here's the latest. Traders looking ahead to next year in the soft commodity market after coffee and cocoa's tear this year. Kona Hake of ED&F Man writing, the outlook for commodities is going to remain sluggish in 2025 due to a potentially strong dollar unless China's stimulus changes demand there. Kona, I'm pleased to say, joins us now. Kona, great to talk to you this morning. So all eyes on China. What is the level? What is the bar of stimulus to change demand, to change your outlook, and to have it more robust for this commodity market?
Yeah, I think this whole 2024 so far, we've had various false starts where China would start some stimulus announcements, and then you just have a mini rally in anticipation of something big, only to get disappointed because actually the stimulus didn't go far enough. The latest bout of stimulus announcements seem to be focusing on consumer demand and fiscal impacts, and I think this could be a game changer. I think this is where you can start seeing a bit more of a different impact on the global, on the Chinese economy, which so far was very concentrated on infrastructure, export, and, that kind of heavy demand type of growth in China, which should in theory have impacted industrial commodities, but didn't have an impact. So now hopefully through consumer demand push, you might see a broad-based growth, which might have a desired impact. But it's, we need to see. We've been disappointed so far.
I was going to say, this has happened quite a few times. You've seen this movie play out before. So is it the specific data you're waiting for, maybe not even the announcements, or once we have the details, the very specific pronouncements of the type of stimulus that's coming, are we off to the races?
No, I think so. Look, so they've had a nice little announcement just before a couple of weeks ago. And I think we need to see more details to come out of that. That then needs to be followed through, and we need to start seeing everything: export data, import data, property sector prices, housing starts, FAI investment. All of that needs to start ticking upwards. Inflation needs to start picking up, but that has been very deflationary in China so far. Once we've seen all of the above, and it's been more than 2 months worth of data tricking upwards, I think that's when you could start seeing some confidence that the Chinese economy is moving the right way in order to encourage the demand that they so badly need.
Kona, it's also been a significant year for soft commodities with weather issues, with various disease issues. But bringing this back around to China, putting these two together, in the last Trump presidency, we saw soft commodities, specifically agricultural, specifically soybeans, really at the front and center of the trade wars. Do you expect a repeat of that this time around?
Yeah, I think that will be a big headwind for the soft commodities and actually commodities generally. I mean, to be honest, my outlook for commodities next year is not terribly bullish because I do think there's going to be a stronger dollar, and the stronger dollar is in turn due to what you were mentioning before, the fact that Donald Trump will become president again and that he has repeated his pledge to maintain tariffs with China, no less. So then you have an issue with, okay, does that then impact China's growth projections? So does that then undo all the stimulus that we were just talking about a second ago? Does that then also cause global trade to fall and the global economy to fall? Because let's face it, when you have tariffs, it does slow demand globally. So that is not necessarily a good base from which you see a launch of commodity prices. So going back to what you were mentioning about tariffs and particularly soft commodities, soybeans got hurt badly. Soybeans in 2024 were performed extremely badly, partly because stocks are very ample. Brazil had a big crop, the USA had a big crop, but now the USA faces a situation where you also don't have your biggest market, China, who you're going to be exporting to. So Chinese demand will probably move to Brazilian soybeans, which means the US CBOT, Chicago soybean futures, will have negative implications because they will not have a big market to export to. So that means potentially big carryover stocks for US soybeans, and that's fairly bearish, to be honest. Same kind of thing.
Kona, that's exactly where I wanted to go, if I can jump in. Just to the extent that China has already diversified away from the U.S., what is their capability to just turn off the taps and demand and buying from the U.S. and go to places like Brazil at the turn of a dime if they wanted to?
Super easy, and they've been doing that already. They've already diversified their trade. They have to, right? You know, that's their one or two tools, if you like, in which they can negotiate versus the USA. They'll say, okay, fine, you want to put trade buys on me? I will no longer buy your soybeans. I've shown you that I can move to China. So I think they will use that tactic, and they can, and they have. They could even do that with corn. The USA will already struggle with their agricultural commodity exports because they're going to suffer from a higher, stronger US dollar. So I think that is a negotiation tactic that they can use, and I believe they will. And as you mentioned, it's already proven to be the case, and Brazil will be a net beneficiary of this.
Hey, Kona, less than a minute here, so just quickly, gold, does the rally continue in 2024?
So the dollar is strong, so that's not good for gold, but there's no shortage of I foresee going forward. And I think that just on safe haven demand, I think the gold could really reach new record highs again, which it has been consistently breaking throughout this year. I think there could be more upside because there's so much uncertainty ahead of us in 2025. So I think gold could do well, softs could do well as well, because of the supply-demand balances as well. Because
Kona, great to have you on this morning. Kona Hack there of ED&F. We appreciate your time this morning. Coming up, we're going to catch up with Dan Greenhouse, Ram Casey of Signum, and Drew Petit of Citi. You're watching Bloomberg Surveillance.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me, but we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely, it's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Early January, we're going to get a lot of volatility.
As we see global growth picking up outside the U.S., we think we're going to see earnings do better outside the U.S.
Inflation still matters a lot to bond investors.
You just need to see decent economic statistics for that to broaden out.
We actually think the economy could outperform again, maybe even above 3%. We expect more of the same as we enter 2025.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Morning from New York City, the final Friday of 2024 for our audience worldwide. This is Bloomberg Surveillance. John and Lisa are still off on this shortened holiday week. I'm alongside Danny Berger in London. I'm Anne-Marie Hordern. Danny, thank you so much for joining me this morning. I was all alone yesterday. You and I both drew short straws. And what are we shaping up here? This awkward moments between Christmas and New Year's after really a stellar year on the stock market. We are seeing a pause into what many were hoping for, a Santa Claus rally, with equity futures just off ever so slightly.
Look, there's going to be a lot of people that read into the negativity of the past 2 days and say, what does this mean? It could potentially just be low volumes, window dressing going into the new year, but I think it is significant that the Santa Claus rally has taken a pause, that it's been such a stellar year, that maybe it does speak to some holding back, to say tech has been so dominant, this market has been so dominant, there's so many unknowns for 2025. Maybe it's the time we just sit back, take a breather, and try to understand where we might go next.
I love the unknowns for 2025. Torsten Slok put this out earlier in the week. Risk to global markets 2025. The first one, tariffs coming at 90%. Also joining Danny and myself this hour. I know he has a lot of thoughts on what's coming down the pipe in terms of policies of next year. Dan Greenhouse of Solos Alternative Asset Management. Dan, thank you so much for joining us.
Sure, I drew the shortest straw.
No, we're very excited to have you, and you're not concerned at all about this pullback.
No, I mean, listen, the S&P, the high was, as you know, is around 6,100. We're at 6040. It's a little bit of a pullback. Obviously, it's a deeper pullback for the equal-weighted index because large cap tech is doing a lot of work. But no, I mean, Danny made the correct point. In the context of the move this year, it's not, I don't think, too concerning.
Absolutely a stellar move. S&P 500 is up more than 25% on the year, but futures are in the red today. It is the final Friday of 2024. We also do have yields though, pushing a little bit higher today, even though Danny's been talking about the fact that we had a very strong demand yesterday for 7-year notes. We do have yields up 2.8 basis points, 4.61% on the 10-year, and crude up just 0.8%, $7. Crude has been trading in this very narrow range that many are expecting to go into 2025 with. Coming up this hour, Rob Casey of Signum on the challenges facing President-elect Trump, Drew Pettit of Citi on why he expects a more volatile 2025, and highlights from Lisa Abramovitz's interview with JP Morgan CEO Jamie Dimon. But we begin this hour, futures pointing to a lower start, but stocks are on track, as we've been saying, to finish the year up more than 25%. Dan Greenhouse says this: I'm not all that worried. This recent sell-off is telling us anything has materially changed. While certainly did not expect this year-end weakness, given strong seasonals, a healthy economic backdrop, strong company fundamentals, and the incoming administration's business-friendly leaning suggests the bias remains to the upside. Dan's joining us for the hour. Thank you so much for sticking with us. So what do you say, I guess, to people who are saying a lot of this has to do with the fact that people are on the sidelines and they are concerned about the policies that no one really knows how they're going to be implemented or the sequencing of them for the start of next year?
Yeah, there's certainly uncertainty about the policies and the sequencing. That is completely fair. The money on the sideline argument I have rejected on air with you guys before, and I reject again. I just find it impossible to believe that however many years, however many quarters into this very strong, very public equity rally, that there are many investors still sitting on the sideline in any meaningful way. Yes, there's trillions of dollars in money markets, but that's not as, I've rejected
$7 trillion?
Almost $7 trillion now. I've rejected the idea that that's money that's instantly going to transfer into Broadcom. That's not how it works. A lot of that money is there for a reason. It's corporate management. It's people who are in fixed income and are not transferring into equity for any reason. So I don't believe that there are many people sitting in cash. As for the policies, listen, I take a more optimistic view on the tariff side of things, which seems to be what most people are particularly worried about, although buying Greenland might be something of a concern for some as well. On the tariff side of things, listen, the consumer balance sheet is quite healthy. The tariffs are certainly going to affect core goods prices. There's no doubt about it. Although, again, we don't know on what goods, who's getting an exception, et cetera, et cetera. But when you look back at the previous episode of the Trump tariffs, there was not widespread discontent. There was not cats and dogs living together. It was not anarchy. Yes, core goods prices, which had been in a years-long decline, reversed that decline. But headline prices were relatively contained. Consumers in general were not particularly affected by it. And if you have a offsetting move in the currency and perhaps some further downward pressure in oil prices, I think on balance throughout the economy as a whole, it's not necessarily going to be quite as bad as some of the pessimists like to suggest.
So much of 2024, we've seen this concentration in the Mag 7, big tech stocks. Do you think 2025 we can actually see a proper broadening out?
Yeah, well, I mean, listen, I would argue we've had a broadening out. Part of the problem with this conversation is those companies are so big, so much better from a profitability standpoint, both top line and bottom line, relative to the rest of the S&P 500, and their weight in the index makes it nearly impossible for any other company to even register in the conversation, let alone actually in the index. But when you look outside of that, everyone, obviously, recently, home builders have sold off. But before that, home builders were having a good year. The defense companies have recently sold off on DOGE concerns. But before that, we're having a good year. Consumer-related companies, a lot of travel companies, the idea that the consumer is constantly running out of money has been rebutted. Some of the larger energy companies were having decent years. The industrial names that were AI derivative plays, Eaton, Trane Technologies, the HVAC companies, were having very good years. Again, cumulatively, they can stack up, but individually they cannot. And so it's hard for them to get attention when so much of the online chatter and the media chatter revolves around 6, 7, 8, 9, 10 companies. They're just not going to get the same play, but they are having very good years.
Well, I thought this was really weird, Dan. There was a report from Challenger Gray saying that in the year to November, 327 executives, chief executives at U.S. public companies announced they were leaving. That is a record exit in this public market. I mean, we've seen the high-profile examples, the Nikes, the Starbucks, for example, but is something happening on an individual company basis that there is more churn and something else going on?
I haven't looked into this. My initial guess to your question, Danny, is maybe with the rise in stock prices, management has found itself in an exceedingly secure position that perhaps they weren't some time ago. And a number of the companies you mentioned are having idiosyncratic problems, whether it's Nike or Starbucks, et cetera, et cetera. So a change in management is going to be warranted, if not celebrated. So no, I haven't thought about it very much. But again, with a multi-year rise in stock prices, it's probably a good time to cash out and go skiing.
I like this idea that the way that we find where all these executives have been is to hit the slopes and hit the beaches, and then we'll find our answer for this. Dan, with those valuations that have moved higher, though, SocGen's Edwards, who, again, is a perma bear, but has written extensively on this, saying, look, the last time valuations were like this, which was 2021, which was fine because yields at that point were 1%. This time around is different. And let's be honest, there's been a lot of naysayers saying that high yields at some point is going to come for this equity market, and it hasn't really. If next year is going to be a year of concerns of inflation and deficits, does it finally come for this equity market?
The phrase "at some point" is doing a lot of work in your question. Like, as every strategist of any ilk will say when they're on TV, valuation is not a market timing tool, and it is not. And so I don't know that valuation is suddenly going to be concerned next year. Maybe it will be, but forget my opinion. Let's look at what's just happened. Everyone likes to note correctly that the 10-year yield is up 100 basis points since the Fed began cutting rates, and this is something that we haven't seen before. When the Fed was cutting rates in 2019, the 10-year went down. When the Fed was cutting in 2007, the 10-year went down by as much as 100 basis points. So you are seeing something of a unique development here on that front. However, what people don't like to mention is that both the market cap weighted S&P and the equal weighted S&P are both up over that time frame that the 10-year has gone up by 100 basis points. So I think certainly there is a concern out there about deficits, about yields, et cetera, but what the stock market is telling me thus far, again, forget my opinion, what has happened over the last couple of months is we have weathered that rise relatively healthily, relatively broadly, and my expectation next year is that's probably going to continue as long as the economy and corporate profits unfold the way that I think I and much of the consensus expects.
10-year has been up 45 basis points just this month alone.
Yeah.
You are pointing to a picture where the equity market has been able to weather the storm of rising yields, but how much higher could they go? At some point, does it bite?
Well, listen, I think 5% is not out of the realm of possibility. We saw it once before.
We saw it this year.
Yeah, that's right. It was a bit of a problem for stocks, and might be again. I mean, again, we've risen 100 basis points. The equal weight is up, let's say 1 to 2%, which is barely up, but up still, better than the alternative. And if you go up another 40 basis points, let's say, and you get up towards 5%, sure, equities might run into a bit of trouble. But again, the question becomes, in a broader sense, why are yields rising? If they're rising because of inflation concerns, that's a different conversation, which is not what's happening. That's a different conversation than if they're rising for growth expectations, et cetera, which is ultimately going to be positive for profits and, by extension, risk assets.
All right, Dan, you're going to be sticking with us. That's Dan Greenhouse of Solus Alternative Asset Management, joining us for the entire 60 minutes, the 7 o'clock hour. We want to get you an update now on stories elsewhere this morning you should be aware of. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. The turmoil in South Korean politics continues. The country's parliament has voted to impeach acting President Han Duck-soo in the latest blow to a government already reeling after President Yoon Suk-yeol's suspension less than 2 weeks ago for his martial law decree. The impeachment was sparked by Han's refusal to appoint 3 judges to the Constitutional Court, which could finalize President Yoon Suk-yeol's removal from power. Meanwhile, China is launching a probe into beef imports to decide if a surge of overseas shipments have hurt the domestic industry. China's beef producers have struggled with huge losses after local prices plunged to multi-year lows due to oversupply and sluggish consumption. The country's Ministry of Commerce says the investigation will end within 8 months, but could be extended. And Richard Parsons, one of corporate America's most prominent black executives who held top posts at Time Warner and Citigroup, died on Thursday. Parsons previously worked as a lawyer for Nelson Rockefeller and Gerald Ford's White House. Parsons was 76 years old. That's your Bloomberg Brief. Anne-Marie?
Thank you so much, Yahira. Up next on the program, hurdles for the Trump agenda.
TradeMasters top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
There is this real momentum from Wall Street.
We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Under surveillance this morning, hurdles for the Trump agenda.
He's looking for victories that he can demonstrate using executive power and really pretty much end running Congress. Because he, was president for 4 years. He understands even with a Republican trifecta, as he saw last week, you're not always going to get your victories quickly or easily through Congress. So you're going to look to other venues and other uses of presidential power to achieve quick victories.
Here's the latest. President-elect Trump and Congress looking ahead to what they can accomplish in the new year. Rob Casey of Signum Advisors saying a red wave does not mean an easy road ahead for the incoming president. Quote, Trump comes into office on January 20th with significant momentum and a clear agenda. But even a Republican Congress will present a hurdle, no ideologically, but functionally. Rob joins us now. Thank you so much, Rob, for joining us this Friday morning alongside, of course, Dan Greenhouse. Okay, so you say this is going to be challenging, but that was already on display, I think, last week. We had basically 3 iterations of potentially how they could avoid a government shutdown, and they did in the end. But what did the whole saga tell you about how Trump is going to govern, even with these majorities he has in the House and the Senate?
Yeah, first of all, good to be with you both. Happy holidays. It showed us, I think, that when you burn institutions down, when you're running on an anti-institution campaign, then when you come into office, you can't then rely on those institutions to do your bidding, right? It's the Republican House majority is a slim majority, and it's a disunified majority. It's going to be really hard for Trump and especially for Speaker Mike Johnson, if he gets the gavel on January 3rd, to really ensure that they always have a majority vote. This isn't, the days of Nancy Pelosi where every Democrat stayed in line all the time. It's going to be hard to wrangle these folks.
Right, 38 Republicans voted against what Donald Trump wanted to see actually enacted. Well, that whole episode, though, kind of got brushed under the rug. What it said to me was that Speaker Johnson didn't have Trump's buy-in when he went to the floor with that deal that was negotiated with Democrats. Do you think he's able to keep the gavel?
I think he probably is, mostly because I'm not quite sure if there's anybody else who could win a majority vote on January 3rd for Speaker. I would think that the next most obvious pick would be Jim Jordan, who is even further right than Speaker Johnson, even closer to Trump than Speaker Johnson is. But Speaker Johnson has done a very good job, and by and large, he really has had Donald Trump's support. Now, Donald Trump is, his agenda is going to be difficult to enact. He's certainly swinging for the fences. I think for Mike Johnson as Speaker, it really is, it's about the art of the possible, right? It's not, he can't get everything done that Trump wants to get done, or at least he can't get it done as quickly as Trump would like. So what can he do, and what can he have Trump's buy-in for if he has to negotiate or cooperate a little bit?
I agree with a lot of what you're saying, and I think the average investor isn't aware. We know it's a race within a majority right now, a couple of seats. Obviously, some people are departing to leave to be in the administration, and obviously Matt Gaetz is leaving Congress in general. But I don't think people are aware when the TCJA passed, Republicans had 240 or so seats. It was a much larger majority, and so forget even the ideological differences that the Chip Roy group, if you will, exhibits. Just mathematically, it's going to be really difficult when you can have 1 or 2 or 3 Republicans banding together to not pass no tax on tips or whatever it is that the administration wants to do. Has Republican leadership talked about how to overcome that hurdle?
Well, I think, first of all, they're waiting on a few more seats to be filled. To your point, to have a slightly larger majority after some of these special elections are run and seats are filled. But, you know, I really think it's going to be a question of muddling through, right? And this is kind of the issue. Generally speaking, Congress is not built for, you know, big, fast change. And it's especially true.
By definition.
By definition, exactly. I mean, that's the whole point. And with Republicans having such a small majority, not only in the House, but also in the Senate, and certainly not having the 60-vote majority in the Senate that they would need to unilaterally pass legislation, I mean, it's going to be really challenging. And I think that that's one of the reasons why we're not seeing TCJA extension talked about in Q1, right? It's going to take a while, conversation and negotiation within the Republican caucus to get that done over, you know, Q3, Q4.
Every congressman and every congresswoman basically becomes king or queen of the Hill, in essence. I think of one person in particular, Congressman Lawler of New York, who basically is saying, I'm not going to vote for anything unless salt's included, because he also wants to run for governor of New York, I think. Wink, wink. I think he pretty much said that in his Christmas, Hanukkah message. So when you have individuals that are so tethered to specific issues, is there in your mind 5 issues that must be included in TCJA in order for it to meet the demands of all these different vying factions?
Well, I think when push comes to shove, the worst case for Republicans is we will see a clean TCJA extension. So if we get to Q4 and there hasn't been, you know, an agreement reached.
So base case.
Base case, we get TCJA extension clean, skinny. I mean, that's essentially what just happened with the budget negotiations and, you know, last week is that there was all of this discussion of, you know, riders and add-ons and this kind of major Christmas tree bill with a bunch of stuff, you know, individuals' preferences and priorities. None of that was in the final bill. There was some farm aid, et cetera, extension of the farm bill, but mostly it's like the lowest common denominator is the clean, skinny package. And given that TCJA for individuals ends end of 2025, I think that the absolute necessity in our base case is that Republicans will pass an extension. Now, the question is, what in addition do they pass? Is it no tax on tips, no tax on overtime, the SALT, you know, extension or relief? I think all of that will be part of the broader negotiation, but much harder to get done.
For the same reasons we just discussed, I don't know how you do any of the other things. There's no built-in constituency in Congress. It's not as if we've spent years building up an argument for no tax on tips or whatever it might be. So to your point about the TCJA clean extension being the base case, I think that's almost your only outcome. It's your bear, it's your base, and it's your bull outcome. Because I just don't see how, when you have 2 Republicans that want one thing and 4 Republicans that are against that but for something else, I just don't know how you come to any sort of an agreement on anything, especially if you're going to try to get 2 reconciliation bills in this year. So I think that's your base, your bull, and your bear outcome. I don't think there's any conversation at all.
Yeah, I totally agree. Congressman Lawler and others will certainly be talking about SALT. And I think that there's a small chance we could see a doubling of the SALT cap from 10 to 20,000.
Sure, the marriage penalty.
Yeah, but other than that, I think it is fair to say that what is the skinny bill, you know, the simple answer is probably going to be the most likely answer throughout this next Congress, because the bottom line is, I totally agree. Once you know, try and bring a few folks on one side, you're going to lose folks on the other side, and so it winds up just being, again, the art of the possible. What can Mike Johnson convince President-elect Donald Trump is good enough, is enough of his agenda to get through, and what can he convince his caucus to vote for?
Okay, I want to talk to you about the fight that was looming yesterday on Twitter. I'm not sure if you saw it. It was between Laura Loomer and actually a ton of other people. I know, Dan, you also saw it. So basically, Musk and the far right, at the end of the day, are arguing over immigration and H-1B visas. Where do you think Trump comes down on this issue?
Well, I think Trump, his focus first and foremost is on the border. So it's not to say he hasn't thought about the H-1B question, the, you know, skilled immigrants coming question.
Be as online as we are. Just to clarify, there is this debate going on among what we call the right that wants to restrict immigration in a broad sense, and what has been known now as the tech right, the Elon Musk world, that agrees in general with the idea of restricting immigration writ large, but also wants to increase the availability of these H-1B visas that provide for the quote-unquote skilled immigration. And those two worlds are clashing for some reason. It happened over the weekend. I guess Vivek Ramaswamy got involved. I would agree that I don't know that the President-elect Trump has spent too much time thinking about the nuances of this, but he has spoken in the past about the need for skilled immigration. He wants to make it possible for those people to come here. I think while this is a fun online conversation, I think the skilled immigration argument is going to win out, because you do have Musk sitting in such an important position next to the president. You have had the president discussing the need for skilled immigration, and it does provide for the masses something of a bifurcation, so you don't look as restrictive by saying, listen, we just want to close the border, to your point, but we also want the skilled people to come here. Is that not where this settles out?
Well, I think it is probably the hope for Donald Trump and Elon Musk, et cetera, right? That's kind of your perfect mix. It's your best, we're going to close the border, but we're also going to allow the best and the brightest into the country to propel our economy forward. The issue is that's just not how the far right sees it, right? And so I actually think that changes to the H-1B program are going to be harder, or I should say easier said than done, right? It makes sense to many of us. It makes sense in the context of the economy as it sits today. Certainly you can have both, right? You can close the border. You can also allow the most skilled in. There's no sort of internal disagreement there. But the issue is, I think, MAGA Republicans, it's not what they want, right? And while Trump doesn't have to get reelected in 4 years, he can't get reelected in 4 years. House Republicans have to get reelected in 2 years. Senate Republicans have to get reelected 2, 4, and 6 years from now. So they have to answer to the MAGA base.
Right. And you made a great point. Musk is definitely not in this far-right Laura Loomer camp. He's battling them, for those that maybe are just kicking up online on exactly what happened overnight. So let's talk about January. We have 60 seconds. Sequencing: immigration, tax policy, tariffs. 1, 2, 3.
I think so. We'll get the first reconciliation package will be immigration and energy. I think the second sort of big conversation, although we're already having it now here, is tariffs. It's probably Europe early, China, I mean early, but most importantly backloaded and very high on and targeted on specific sectors. And then the tax question is going to be 2H. And the bottom line is it's because the Republicans don't have the package around which they can form a majority today.
Rob Casey, thank you so much for joining us this morning, and happy holidays and happy 2025. Rob Casey of Signum Global Advisors. Coming up on the program, highlights from Lisa's interview with Jamie Dimon last month at APEC in Peru. You're watching Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Happy Friday. Good morning. Welcome to Bloomberg Surveillance. I'm Anna Maherdern. John and Lisa are still off on this shortened holiday week. Santa Claus rally, no more. We do have a pause when it comes to U.S. equity futures. This is the second straight session where we are in the red, although we should note trading volumes are very light, and we've had an absolutely stunning year when it comes to this bull market. S&P 500 is up more than 25% this year, but you can see across the board, S&P 500 futures down 0.3%, alongside the NASDAQ 100 futures and Russell down 0.4% as well. Across asset this morning, a lot of moves, and there has been, of course, over the course of the month in the bond space. 10-year yield at 4.6% this morning, up 2 basis points. Danny was talking about how we had this such strong demand yesterday for that debt sale, 7-year auction. I believe that was the final one of 2024. Lisa will keep you in the loop on all the debt auctions you need to be looking out for 2025. But the 10-year yield has risen 45 basis points so far this month, about 100 since the first Fed cut. Dan Greenhouse, who's our guest host this hour, has been talking about the fact that it's okay. Equities have been able to rally with this level of yields. And then when it comes to foreign exchange this morning, euro dollar sitting around 104. Of course, the euro is going to have a very challenging time at the start of 2025. France has a new cabinet. They need to pass a budget. Germany's going to have fresh elections. All of this, coupled with this uncertainty of these two political crises in the two biggest economies in Europe, is the fact that they are going to have to contend with Trump 2.0, whether it's the Fed, whether it's financial markets, or whether or not it's the European Union. They're waiting to see what Trump and the second iteration of his administration brings, especially when it comes to tariffs. Under surveillance this morning, the Bitcoin rally taking a breather, with investors opting to take profits ahead of what could be a volatile stretch ahead. The crypto market is bracing for a number of option contracts to expire today, with warnings of a, quote, choppy market to come. Isn't that the point, Dan Greenhouse, of Bitcoin, a choppy market? Although we have to say, this has been on a tear since Trump's election. I think he actually tweeted, "You're welcome."
Well, if you're a Bitcoin investor and you own anything adjacent to Bitcoin, yeah, you should probably be.
Are you in this space?
Solus owns a couple of Bitcoin adjacent securities. I don't think we invest in Bitcoin specifically, but we do own some stuff that benefits from mining, et cetera, et cetera. Listen, I think it's hard to view this as anything other than a risk-on asset right now. I know there are a lot of people that treat it as a store of value.
They're talking about maybe a crypto strategic reserve.
Yeah, Rob Casey talked about easier said than done. I think that might be the case for this as well. But those are the types of suggestions that you get from the incoming administration, which help drive the price from 60,000 to 100,000. And I know Bloomberg has a story up this morning talking about the rally fizzling. I wouldn't call being down a few $1,000 from 100,000 as fizzling. The investor enthusiasm for Bitcoin is just as strong as it was yesterday, and you have any number of people out there, Mike Novogratz, et cetera, saying it's going to 200, 250, 300,000 in fairly short order. If this level of momentum continues, then that certainly could be the case.
Also under surveillance this morning, Russian President Vladimir Putin casting doubts on the future of natural gas flows from the country to the rest of Europe. The move sending benchmark futures higher. The loss of Russian gas would could force Eurozone countries to rely more on alternative sources, with the U.S. already ramping up LNG shipments to the continent. What's interesting about this is that, well, we do see the price action right now of Putin's comments, but actually Europe was already talking about the fact that they might need to buy more from the United States. And Ursula von der Leyen, after President Trump was elected, said, well, maybe we can blunt some of these tariffs by buying more U.S. LNG. Is this something you foresee happening, potentially how policy can meet demand of the market?
Yeah, I think so. Europe in general has to figure this out because they are, for lack of a better word, subservient to this market and this supplier. And I think it's the great irony of the last couple of years that in an effort to diversify itself away, it ended up becoming susceptible to this type of market development. Say what you will about the United States and our slower adoption of EVs, et cetera, we are in an enviable position relative to Europe with respect to energy demand and sourcing. And I think, again, Europe is going to have to figure this out over the next couple of years. What's going on in Germany is related to this. What's going on in Europe more generally is related to this. And it's a story that's going to unfold over the next 3 and 5 years. And I pray, just as a citizen of Earth, that they make the correct decisions over these few years.
Okay, also under surveillance this morning, Christmas Day, bringing ratings joy to the NFL's Netflix debut as well as the NBA. The NBA's 5-game lineup averaged over 5 million viewers throughout the day, marking a 5-year high, and Netflix drew an average audience of more than 24 million for its 2-game slate, setting a record for NFL streaming. A lot of this, I think, had to do with the fact that Beyonce was there. I talked about this stat yesterday, and I think it's interesting. Netflix agreed to pay $150 million to broadcast 2 NFL games on Christmas. That is $50 million more than producing a season of Game of Thrones for 2 games. This came from The Athletic. Did you tune in?
I watched. Of course I did. Beyonce's at halftime. Of course I'm tuning in. Listen, Netflix is $925 a share. They are doing a lot right. And I think...
Stock is up 90% this year.
It doesn't get included in the Mag 7, but it's one of those names that's Mag 7 adjacent, we'll call it. Listen, the NFL is the dominant live sports, live entertainment viewing option across linear, across streaming, et cetera, et cetera. To put 24 million in context, everyone loves Succession. Something like 1 or 2 or 3 million people watch Succession. It's just... The NFL, as everybody knows, dwarfs everything else from a rating standpoint. So if you're Netflix and you're trying to diversify away and get into video games, if you're trying to get into live sports, you saw this with Mike Tyson, Jake Paul, the NFL is the best and the brightest, so to speak, and it's absolutely, from a viewership standpoint, the right decision. Although I will push back and say a lot of it did not have to do with Beyonce. 24 million people watched. It spiked up to 27 million during the halftime show.
Yeah, it spiked during Beyonce.
It did. Other people viewed in for Beyonce. I was one of those, sure. I like a good, what are the Beyonce people called?
Beehive.
Oh,
are you part of the Beehive?
No, I'm not part of the Beehive.
I think maybe you are.
I don't
if
think
you
I'm
watch
the
the
target
halftime show.
audience.
One thing is for sure, there was that technical debacle when it came to the Jake Paul, Mike Tyson, and I think Netflix was able...
None of that yesterday.
None of that yesterday. Netflix was able to prove it, and maybe this means actually these broadcasting rights are just going to go higher and higher because people are tuning in for them. All right, JP Morgan CEO Jamie Dimon says the next Trump administration will inherit, quote, the most complicated geopolitical landscape since World War II. Dimon sat down with our own Lisa Abramowitz at the APAC CEO Summit in Peru earlier this month and talked about his expectations.
You had a big sea change that took place in that vote the other day, and some people were prepared and some weren't prepared. But I think the most important thing is whoever had been elected, and this is my belief, they are entering and going to be responsible for the most complicated geopolitical, military, and geoeconomic situation that the world has faced since World War II. And of course, I wish them all the best. I think people try to help get through this. It could be a difficult thing with a lot of unknowns and uncertainties, and so policy is going to matter. And of course, who runs the government will be determinative there.
President-elect Donald Trump sends a message to you that he respects you greatly, but you will not be part of the Trump administration as a Treasury Secretary. If that were something that were interesting to you.
First of all, I wish the president well, and thank you. That's a very nice note. But I just want to tell the president also, I haven't had a boss for 25 years. I'm not about ready to start.
I want to start by also talking about the response in markets in the U.S., which has very much been, this is going to be a pro-growth shock. with companies that are going to be investing much more, deploying cash, aggressive in terms of U.S. expansion. Have you seen any signs that that's truly the case?
Well, yeah, you've already seen, the markets have responded quite well. And, I think America needs a growth strategy, so I literally applaud that. I think collaboration between government and business is the way to have growth. They've already spoken about a deregulatory environment. I want to point out, I'm not talking about just getting rid of regulations, but the regulatory environment in most countries has become stifling. And in a lot of countries, including Peru, it's why you're growing maybe at 2.5%, not 4 or 5. In America, it's why we've been growing at 2% for 20 years and maybe not 3. So I do think it's a reasonable thing to have that kind of reform. And that reform has to go deeper than just regulations, which can unleash capital and investment and banking and stuff like that. It's got to be permitting and all the related things that come with that, where people, you were just mentioning a mine that, someone bought that could do rare earths in the United States. It's 10 years. They haven't gotten their permits yet. I mean, it's a shame, and we're doing this to ourselves, and it's a mistake. So I applaud any government that says, I'm going to make government more efficient. And I think inefficient government is one of the reasons that people are frustrated. That why you have some populism, because they may blame, they may look at big companies, but they also know their government isn't spending their money wisely.
Diamond also spoke to Lisa about the ability for the incoming Trump administration to fast-track M&A and loosen banking regulations.
Because they have the Senate, the House, and the presidency, they have far more ability to do things like that. I think last time around, President Trump had started by saying for every new regulation, 1 in, 2 out. And I think later I said 1 in, 5 out. I think they're going to do some of that again. I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit. And so and you could have kept the banks equally safe, but had them do more credit. And so, to just give an example, the average bank in America, I think the number used to have $100 of deposits and $100 of loans, and now it's $100 of deposits and $65 of loans. And if that's what you want, if for some reason the regulators think they're geniuses, that's the best way to run the banking system, so be it. But I think they did a lot of things that ended in that answer, but they didn't know that was going to be the outcome. So, and I think you could talk to any industry, and they'll give you examples of regulations that could be reduced that make it easier for them to do business while keeping the country safe, while keeping the air clean, while making sure the EPA does its job, et cetera. So I applaud them. They should be looking at those things.
Do you think if there is, particularly in the banking sector, less regulation, that there will be an even steeper competition with banks getting back some of the business from private investment firms?
Probably, yeah. I mean, because if you look at, you're asking about private credit and private investment, which I'm not against, and it has grown very rapidly, and it's got pros and cons. I'm always in favor of competition, but part of the reason that they are dancing in the street, which they said publicly, they used to get mad at me, now they say, no, he's right, is half the capital. No social requirements, no AML, no BSA, no fiduciary, no reporting to the government, no insurance, no liquidity. It's a huge disadvantage. So, I think it'll make banks get back some of that business. I think it'll be more important to regional banks than to J.P. Morgan.
There's also a question, whether it's banking mergers and acquisitions or just more broadly, whether there's going to be a more amenable administration to tie-ups. Are you seeing from your conversations in the past 7 days with companies that they are looking to expand their M&A pipeline to start putting that together?
Yeah, so absolutely. I mean, a lot of M&A was stymied by the fact it's not just sometimes you can't get through the courts or something like that, but it takes 2 years. It takes 3 years. So make believe you're a bank, and we've seen this happen. And one of these deals actually took 3 years. It takes 3 years to get it done. So you've done a deal. It's binding. You haven't closed it, but now you've got to run the company. You can't get the synergies. You're going to be losing people. You want to start working in a common culture and common technology. You can't do it. So a lot of companies are looking at will be looking much more aggressive at acquisitions and deployment of capital, and they should.
One of the highlights of the year, that was Lisa speaking with J.P. Morgan CEO Jamie Dimon. Dan, they're talking about M&A there, and a lot of people are talking about the fact that M&A has been actually sitting on the sidelines, and there's a ton of pent-up demand, and the regulatory environment looks a little bit more friendly now.
The regulatory environment can't get worse, I guess. So
the JetBlue CEO also said that to us in terms of antitrust. Couldn't get worse than where it was.
Yeah, that's right. Ultimately, what matters for M&A activity is is if the economy remains strong, balance sheets remain healthy among the acquirers, then that's ultimately going to be the biggest tailwind. Obviously, the regulatory change in environment, Lena Khan, Jonathan Cantor, et cetera, not being there is going to be something of a tailwind for sure. And so in general, I think you should certainly expect an uptick. We've already seen numerous headlines of companies talking about potential mergers and acquisitions or acquiring targets. You've seen indications what's going on with it's not exactly related to this, but what's going on with Comcast and Warner Brothers, where they are in some cases spinning out or segregating their linear business in the hope of maybe doing a merger, is probably partially related to this, the environment being a little more friendly. I think that's going to continue for most of the year. I think the one pushback I've had on this topic, or the main pushback I've had on this topic, is the idea that somehow the incoming administration is a traditional Republican administration in thinking about mergers and acquisitions. And I think there is a strain of thought in the J.D. Vance camp, in the J.D. Vance part of the Republican Party, that thinks that mergers and acquisitions are not exactly the great benefit that traditional Republicans have thought, that consumers have been harmed, workers have been harmed to a larger degree than perhaps previously thought.
Right, and it comes to big tech. J.D. Vance actually said Lena Khan was one of the few people in the Biden world doing a very good job. Yeah, so definitely something and a good caveat to point out. All right, let's get you an update on other stories we're watching this morning. Here's your Bloomberg Brief with Yahira Hackis. Hey, Yahira.
Hi, Anne-Marie. Azerbaijan Airlines plane was damaged by Russian air defense systems before it crashed in Kazakhstan. That's according to a government-backed news site. The plane was struck while approaching Russian-controlled Chechnya, according to the report, which said the aircraft's communication system was completely paralyzed. Meanwhile, South Korean companies linked to Netflix's Squid Game series fell in today's trading after a disappointing Season 2 debut. The survival thriller was a massive success when it first dropped in 2021 and topped Netflix's most watched titles on every continent. The new season, released yesterday, received poor reviews. Meanwhile, in sports, Liverpool is marching closer to the Premier League title after beating Leicester City 3-1. Superstar Mo Salah scored the game's final goal, bringing Liverpool's lead over second-place Chelsea to 7 points. Chelsea, for its part, dropped a key Boxing Day match to 8th-place Fulham, and Nottingham Forest continues its stunning season with a win over Tottenham, giving them a 1-point edge over Arsenal for 3rd place in the league. That's your Bloomberg Brief. Anne-Marie?
And poor Danny was at that Chelsea match yesterday. Danny, we're very sorry for your loss. Up next in the program, bracing for the new year.
This year, though, everyone's kind of been looking for that opportunity to buy. Maybe we get the Santa rally, but I think come early January, we're going to get a lot of volatility.
Doesn't look like we're getting that Santa rally this morning. Equity futures are softer. That's coming up next. You're watching Bloomberg Surveillance.
You've released, I think, a Bollywood song, a reggae album, a gospel album. You've done a bunch of different genres. Is there any genre you haven't tried that is, because it feels like this next one you're doing is sort of back in your sweet spot?
I did a jazz album that I haven't released yet. It's more or less like spoken word over jazz music. That was a genre that I've always wanted to go into. Quincy Jones hit me to Mr. Mumbles, Clark Terry, which was his teacher. And we had an opportunity to spend time with Mr. Terry, and we did a record together, and that was a genre that I always wanted to venture into because I felt like I had a jazz voice.
So your role in a jazz album is just your singing?
No, I'm spoken word.
Or spoken, sorry.
My voice and my conversation, my poetry, you know.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent the Bitcoin on beer and groceries and gas and video games.
And
I wish I had kept it. I wish I would buy a Harley today if I had.
Yeah, but you probably wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that is.
I'd be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Romaine Bostick in Detroit, and this is Bloomberg.
Good Friday morning, final Friday trading day of 2024. And what a 2024 it has been. S&P 500 has been up more than 25% this year. Although it doesn't look like the market's going to get its Santa Claus rally that it was hoping for. We do have equities pulling back ahead of the open in about 90 minutes time. S&P 500 futures down 0.3% this morning. Euro dollar at 104. We've been talking a lot about the political crises that have been inflicting Europe, whether it's Germany, whether it's France, and how this lack of cohesion as they are dealing with an incoming Trump administration. A lot of analysts are calling for parity in 2025 when it comes to euro dollar, which came into the year around 110. Bonds this morning, we do have the 10-year yield at 4.6%, up 2 basis points. This comes after strong demand yesterday from the 7-year note. And New York crude this morning, $70.35. Very narrow trading rate over the course of months when it comes to crude. A lot of this has to do with supply and demand picture, and a lot of people are expecting that to also continue into the new year. Under surveillance this morning, bracing for the new year.
This year, though, everyone's kind of been looking for that opportunity to buy. We had the dip post-FOMC. I think people bought that dip. I think people are going to have to digest what does it look like in the new year with President Trump, with Musk. Maybe we get the Santa rally, but I think come early January, we're going to get a lot of volatility.
Here's the latest. S&P 500, NASDAQ 100, and Russell 2000 all looking to finish the year with double-digit gains, leaving many investors anticipating next year's market move. Drew Pettit of Citi writing, quote, expect a more volatile phase of the bull market next year. Overall, a lot of good news is priced in, meaning Q4 reporting and first 100-day policy pushes could create bouts of volatility. Drew joins us now, and of course, Dan Greenhouse is still with us. So, Drew, what are you expecting that first 100 days of the Trump administration, since everyone coming on this program says we have to wait for the policies?
I think that's the beauty of the setup. I don't know what to expect, and I'm not really sure if markets really know what to expect. I think that creates some volatility. Look, in conversations with clients, we've heard a lot about immigration fears. We're worried about tariffs. And then on the other side, you have the deregulation angle. So when we talk about a bull market entering a volatile phase, yeah, we think fundamentals are strong, but all these little drips of news here and there probably bounce you around a little bit. And you probably see a little bit more aggressive rotation between sectors and size and style as well.
Drew, do you feel like investors you talk to are actively changing portfolio allocation because of the immigration concern? I know everyone's concerned about it and everyone's talking about it and worried about the potential for inflation, but is anyone actually doing anything about it?
I don't think so. To be honest with you, I don't think anyone's even making a whole lot of aggressive deregulation trades. You really saw the banks in some of these sectors, even like energy as well, like pop post-election, but you've seen that rally fade. So they really haven't bought into the long-term trade there. And on immigration, same thing. Everyone's trying to figure out what might hurt the consumer, even on tariffs too. There's a lot of talk, everyone's sharpening their pencils. So when we finally get the news event, whether it's good or bad, I think that's when you'll start to see the trade, and that plays into why we think we'll see some volatility in the first half of next year.
You know, you might not be seeing a lot of trading around the regulation side of things, but isn't it fair to say if you look at the defense stocks, Lockheed, General Dynamics, et cetera, that you have seen a Doge-related trade going on?
I think there's just a lot of concern about government spending in general. You can honestly say that's shown up in bond markets probably more than it's shown up in equity markets. You know, to us, I would say, yes, you've seen some of that. That's completely fair. We do still think there's some risk there on the industrial side and capital goods. But honestly, could it be a rate thing? Could it be a debt thing? Could it be Doge? I think kind of, you know, pick your narrative.
So I guess when you put it all together, the question for investors going into next year is we've had two really strong years for the S&P 500, 20+% back-to-back. For the equal weight index, a more moderate but still good back-to-back year, call it 11, 12% back-to-back. I sense a lot of hesitancy going into next year. I can't be too bullish because we've had such strong years. Obviously, there's volatility and uncertainty about the administration, but the 2 years gives a lot of people pause. Well, we just can't see a third good year again. Is that a fair way to characterize how people are thinking about it, and do you agree with that?
I actually don't agree with that. I think investors might be saying that. They might be talking about that on the fringes, but when you look at the data, the price action alone, look at margin debt, look at TRF volumes as a percent of the tape, look at even some of the other sentiment gauges, including our Levkovich index composite, I think markets are still really euphoric. Where we get a little bit concerned on this front is everyone's talking about their concerns, but you're not trading them. So they're telling you one thing, doing another. So everyone might come on, talk about volatility. They might talk about being concerned. They might talk about having no real corrections in 2024. But at the end of the day, they're buying equities. They're bullish.
Drew, thank you so much for joining us, and Happy New Year to you. Drew Pettit of Citi, Dan Greenhouse of Solus. Thank you for joining us this hour. Some final thoughts with you. You know, your number one advice for 2025 after being in this market in 2024?
Have a friend with you in the New York City subway. I think that's my number one advice. Now, outside of that, on the investing side of things,
I mean in financial markets.
Yes,
very funny.
Sometimes you have to clarify with me, but listen, I admittedly take an optimistic view of the landscape. I get that. There are things about which one should be concerned. My pushback is there's always things about which one should be concerned. And while I'm admittedly taking an optimistic view of things entering the next year, I base that on data and reality. We saw tariffs once, weren't terrible. We saw a change in administration, wasn't terrible, and my bias is to the upside as a result of that.
Well, thank you for spending your shortened holiday week, Friday, with us, the final Friday of the year. Coming up in the program, Anna Rothbun of CBiz and Kate McShane of Goldman Sachs. This is Bloomberg.
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry. And so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure of, and systems has a little bit of that because NVIDIA is so far ahead, it's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan. What we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner take all in that space. You're going to have to earn that spot. Whereas, it'll be fun to watch what happens. And I think there's going to be a lot of money burned in the process because somebody will develop something and a fast follower will come along and make it better and cheaper because data gets cheaper and more pervasive. And it's going to be easy for new players to come in and do interesting things. So I think we wait and we see.
The The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भाला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Come early January, we're going to get a lot of volatility.
As we see global growth picking up outside the U.S., we think we're going to see earnings do better outside the U.S.
Inflation still matters a lot to bond investors.
You just need to see decent economic statistics for that to broaden out.
We actually think the economy could outperform again, maybe even above 3%. We expect more of the same as we enter 2025.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning and welcome to the final Friday of 2024 for our audience worldwide. I am Anna-Marie Hordern alongside Danny Berger, who's joining me in London today. Danny, very good morning to you. The Santa rally is not shaping up to be one. We are hitting a pause after yesterday's muted session, although it is a very shortened holiday week, and we cannot negate what was a stellar 2024 when it comes to these equity markets. S&P 500 up more than 25%. But the year is drawing to close, and right now it's drawing to close on a red note.
Yeah, it is, but it hasn't really changed opinions. You were just talking to Dan Greenhouse saying, look, I have an optimistic view. The outlook for this equity market is a strong one, with calls as high as 7,000 to end the year. Where you get less consistency on the calls, Anne-Marie, and I think this is really fascinating, is the bond market. You have very different views. You have a bearish view coming from Deutsche Bank that 4.7% is their target for 10-year yields. Then you have someone who's more positive, like Morgan Stanley, 3.6%. So much is going to depend on policy, but it is a torn bond market despite the cohesion of the equity market. Both can't be true at the same time, but to be fair, it has been the enthusiasm of the equity market that's called this economy right for the most part of 2024.
Right, and Dan Greenhouse has been talking about the fact that even though we've seen even just this month alone 45 basis points higher in yields, the fact of the matter is equity markets have been able to deal with it. It is point number 8 on Torsten Slok's risks to global markets in 2025. U.S. 10-year interest rates move above 5% before mid-year at 40%. Some of his top risks, tariffs coming in at 90%. NVIDIA earnings disappointing, another 90%. U.S. economy reaccelerates and animal spirits coming back, 85%. Danny, you know what is last on the probability list? And it has a 0% chance, a U.S. recession.
because how many people called for a U.S. recession at this point last year? In 2023, to end the year, we're saying a U.S. recession is coming. We're going to get something like 6 cuts from the Fed. All of those were upended. Bond investors were really, really punished for those that put that trade on. We've learned that betting against the American consumer and this American economy has been a losing bet. For now, those fears of economic weakness, they've been turned elsewhere to China and Europe.
Right, and how much is that U.S. exceptionalism going to withstand the test of 2025, especially when we have all of these unknowns? Okay, so this is where we're shaping up when it comes to the equity market this morning. As Danny and I have been talking about, S&P 500 futures, it's been a stellar year, but futures are down nearly 0.4%. Euro dollar this morning, one to certainly watch in 2025, as many are calling for potential parity as we see paralysis in the core of Europe and France and Germany. 10-year yield up 2 basis points, 4.6%. And New York crude, NYMEX crude, $70.30 this morning. Coming up in the program, the 8 o'clock hour of surveillance, Anna Rathbun of CBiz with the Santa Claus rally taking a breather. Kate McShane of Goldman Sachs, why she sees upside for retail stocks next year. And Chuck Lieberman of Advisors Capital Management on inflation risks in 2025. We begin this hour with stocks on pause heading into the final days of the year after a blistering rally for equities in 2024. The S&P 500 up more than 26% year to date. Anna Rothbun of CBiz seeing upside ahead next year, writing, assets will go where there is higher relative value. From this perspective, we are still constructive on U.S. equities and even tech, despite the high valuations. Anna joins us now. Anna, thank you so much for your time this morning. So with all these uncertainties going into 2025, what are you most keenly looking for?
Good morning. Santa Rally may not be here, but maybe Santa's telling us that we've had a lot of returns in the last 2 years. And from that perspective, it's difficult to imagine a 2025 where we're going to continue to see this type of return. So going into 2025, we are still, as you read, constructive on tech because we see that it's not just a want to have in terms of AI and other developments, it's a need to have, especially for corporations that are developing AI. If they're not on top of it, they're going to lose out. And from that perspective, I think we're going to continue to see R&D, we're going to continue to see new developments, and we're going to continue to see that AI development being filtering down to other sectors and potentially seeing something that is, increasing productivity levels more than we may have anticipated in the past, and that's going to catch up with us pretty quickly.
Anna, great to see you this morning. For investors who just buy a simple index fund, they've got a lot of NVIDIA in there. This is a point that Torsten Slok makes that Anne-Marie was mentioning, that the big have gotten bigger. He says it's a risk, that investors are underappreciating that they essentially have a portfolio leveraged to NVIDIA. Is he right?
That is always a risk. Concentration risk is something that if you're an index investor, you really can't help. But at the same time, we have been talking about concentration risk for, 2 years. And if you weren't in the index, you would have missed out. There are a lot of active managers that have been underweight those names that have missed out. So I think that despite the fact that NVIDIA is a big holding, there may be a reason why. Maybe investors telling us that, okay, their exposure to AI and their advancement in AI may be something that the valuation can actually justify.
I was going to say also, Anna, if you had bet on valuations that they were too high and used that as a market timing tool, you also would have missed out massively. We still constantly hear the calls, though, that they can't sustain themselves, even as you see yields going higher, that's going to be an issue, that at some point valuations need to come back to earth. Is it different this time around? When we're talking about AI and the future promise of earnings, do we need to recalibrate just what valuations can and should look like?
Whenever people say, it's different this time, it never is. So I'm not going to join that. I'm not going to join that camp. But at the same time, certain things are different. For example, when internet came out, it didn't exist, right, before, and we had to readjust. I think it's the same for AI. In terms of valuations, I think this is why you have to diversify in your portfolio, especially because we're capital allocators. We don't bet on a single sector. We don't bet on a single stock. We make sure that we're diversified because at the end of the day, market timing is possible and valuing tools. So while we recognize that there are risks in valuation, we actually don't try to time the market with it.
Anna, I love in your note that you call inflation the Fed's favorite child when it comes to, their dual mandate. Were they burned by the transitory episode? Is that what you think is really driving a lot of what we saw at this month's Fed meeting?
Yeah, I think that 2 years ago now, I think the Fed was using data and judgment, right? And they're saying, okay, this is transitory because this data movement that we're seeing may be short term. And then they did get burned. And I think they're overcorrecting now. And they're responding to short-term data movements. I mean, all it took was, 2 or 3 months of CPI data coming in a little hotter than expected. And we're talking about a little hotter for them to say, okay, now inflation is front and center, despite the fact that we've been telling you for the last 6 months that it has been employment that has become front and center. So I think that going into 2025, even if we have a little bit of weakness continuing in the labor market, they're going to look at inflation and say, okay, this is still our priority, even if we see labor market starting to deteriorate.
You mentioned there the reaction of the Fed to every data point. This is something Mohamed El-Erian argued earlier in the week in an FT column, essentially saying that they've become hyper-dependent on the data, and it's a problem for both the market and the economy. Anna, is it a problem?
I do believe so. First of all, data don't move in a smooth way. Data are by nature volatile, which means that their perception of how the economy is doing, and therefore potentially communication and monetary policy, it's going to be volatile. So for the markets, that's very confusing. For the economy, if you're data dependent, that means you're relying on lagging information. And so you have to accept the fact that, and there's no getting around this, you have to accept the fact that if there's no judgment involved and you're constantly looking at backward-looking data, then you might actually be late. And it's the same mistake that the Fed made when inflation was going up, maybe the same mistake the Fed makes when inflation is going down.
Anna, thank you so much for your time this morning, and Happy New Year to you and your family. Anna Rothbun of CBiz. We thank you for your Friday morning contribution. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Hackes. Hey, Yahira.
Hi, Anne-Marie. Israel struck multiple targets in Yemen that it said were controlled by the Houthis, including military infrastructure and power stations. The strikes led to at least 6 deaths and 40 injuries. The operation was in response to repeated Houthi attacks against Israel, capped off by a ballistic missile strike on a Tel Aviv playground. The Houthis have pledged to keep attacking Israel as long as the war continues in Gaza. Meanwhile, pregnant women infected with COVID-19 were found to have a higher risk of severe complications, including emergency C-sections and even death. According to a UCLA study, 14% of infants born to mothers who tested positive for COVID-19 showed signs of developmental problems. Researchers caution that larger studies are needed to confirm the link. And in sports, the Seahawks keeping their playoff hopes alive after beating the Chicago Bears in Thursday Night Football. Seattle held the Bears to just 3 points and intercepted a late pass from Bears QB Caleb Williams to seal the win. Seattle needs the LA Rams to lose to keep their playoff hopes alive. That's your Bloomberg Brief. Anne-Marie?
Thanks so much, Yahira. And Yahira will be back with us for an update in about 30 minutes' time. Coming up in the program, Kate McShane of Goldman Sachs and her top retail picks for 2025. That's coming up next. You're watching Bloomberg Surveillance.
economics to the world of business. Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the It's the Friday after Christmas and before New Year's, and if you are trading today, hats off to you. You're maybe one of few, but it is an equity market that is on track for its second consecutive day of declines. This time around, it is being led by small caps. Your S&P 500 future session down by about 1/3% after a very strong 2024 and optimism for 25. Euro versus the dollar, that's at 104 this morning. Stronger euro by about 0.1%. Your 10-year yield, that comes under pressure, higher by 1.6 basis points. We're just under 4.6%. It was a strong duration bid yesterday, a 7-year auction that went on without a hitch, despite the fears of a deficit coming for 2025. How much longer do the strong auctions keep this bond market chugging along? NYMEX crude, that's trading at $70.23, just under 1% of a rally this morning. When it comes to the holiday season, Bloomberg Economics reporting a slight drop in holiday shopping this season compared to a year ago. Retailers noting a bifurcated consumer with demand staying solid from middle to high income consumers. Pleased to say that Kate McShane of Goldman Sachs joins us now. Kate, great to catch up with you this morning. Look, this holiday season is no exception. It is the bifurcated consumer that we keep hearing over and over again. Is there any reason to expect that we might hear anything different in 2025?
Good morning. Well, we do think that we could see slight improvement in the lower income consumer in 2025. What we're looking at, which is our discretionary cash flow analysis that we put out 4 times a year, is measuring how much cash flow the consumer will have going into 2025. And overall, the consumer's cash flow should increase about 5.2%. in 2025. That is being led by the higher income demographic, which is expected to grow about 5.5%. But the lowest income demographic, discretionary cash flow, is expected to grow 4%. And so there is healthy growth there. I think disposable income is moderating a little bit for the consumer, but you are seeing some easing of financial obligations with an easing interest rate, of course, and then seeing dissipation of inflation.
What consumer companies benefit from that, Kate? Because one of the fascinating trends of this year has been companies that you usually associate with lower income consumers. That of Walmart, being able to get greater market share from middle and upper. So if the lower starts to participate more, is it the same companies? Is it a broader rally that encapsulates more types of consumer companies?
It's a great question. I think for sure Walmart has definitely capitalized on being able to address a wider array of consumers, both lower, middle, and higher end, as you mentioned. The ones that still cater to the lowest income consumer, which are the discounters like Dollar General and Dollar Tree, have actually been impacted by the fact that that lowest income consumer has been troubled or dealing with such high inflation, with most of their dollars going towards consumables versus discretionary, or just more choiceful decisions even within consumables. So if the lower income consumer is a little bit healthier in 2025, you could see slightly better trends at the discounters who cater to that lower income consumer, which is around $30,000 income and below.
For the Walmarts, for the Costcos that have been winning market share, Kate, in times past, it's been used as a signal of a not a good thing, that there's a downturn. People are more concerned about their wallet. They're more concerned about savings. That hasn't been said this time this year. Why is this time different? Why is it not a signal that we should take that things are deteriorating among the consumer?
Well, the success of Walmart and Costco, I think, is much more a testament to execution than anything really with what's going on in the macroeconomic environment. Walmart, if we can take as an example of what's happening there, from an execution standpoint, they have really benefited from improving their general merchandise category, their overall store experience, their omni-channel, being able to both be an online and brick and mortar retailer. And given all of those things, including fulfillment and Walmart Plus, which is their subscription service, they've been able to cater to this much wider swath of consumers, which has resulted in quite a bit of growth. They also are very focused on price, of course, which in an inflationary environment did attract quite a few consumers to them as well. But Walmart's success, I think, can be more attributed to the fact that they've been investing in their business, in technology, in building out their fulfillment optionality for consumers, and it's been more execution.
The building out of the online key, I'm really interested in this for a different reason maybe, because online shopping has been just so popular. It has since COVID and it's taken off. The figures for this holiday season show really robust growth from Adobe Analytics and how much people are buying online. But with that comes things like returns. And for these companies, that's a problem because not only do they often have to pay for the return, a lot of times they get these products back, you can't sell them again, there's something wrong with them. All of that would eat into margins. Kate, is that a problem for companies? Do companies need to think of a kind of strategy for dealing with especially margins in an increasingly online shopping world?
Well, I think that is the benefit of being a brick and mortar retailer, being a true omni-channel retailer. I joke around that I am a retail analyst, so we do believe in the existence of stores and the need for stores. But when you think about it, the physical retail is really important. Think about this holiday season, for instance. There were 5 less shopping days this holiday season than there was last year, and everybody was talking about what a big rush there would be because there were 5 less shopping days. That is going to be able to be fulfilled by stores that can stay open to 10 or 11 o'clock on Christmas Eve. So that physical real estate is really important. And we're seeing that with regards to the optionality it gives the consumer too, whether it's buying that product or returning that product. So again, if you were to look at some of the big box stores like Walmart and Target that have thousands of points of distribution through their store network, they are able to get to the customer online, but that customer can get it by picking it up in the store. They can get it delivered out to their car, or they can get it delivered to their house. And that's been a real game changer for anyone in brick and mortar retail that's been able to improve that customer service and in terms of the optionality they're providing for that consumer. And it goes for returns as well.
Kate, another possible big headwind that a lot of these retailers have coming into 2025, and it's no surprise to anyone because this is something we all talked about heading into this election. I think I know where you know where I'm going, is supply chains and the risk that it's going to get a lot more expensive, not just from China, but where other companies have migrated to South America, for example, to Mexico. How nimble and ready are some of these retailers if tariffs are put on in their ability to move more locally?
Yes. So we have seen with our retailers some change in the supply chain since tariffs were last implemented by the Trump administration in 2018, 2019. You have seen production taken out of certain countries and moved to others. There are going to be categories that aren't quite as nimble or can't move as readily as other categories. Consumer electronics is the one that comes to mind that still very much is imported from China. But for the most retailers that we cover, you have seen some diversification in that supply chain over the last 6 years. So there is some reduced risk than maybe there was 6 years ago. But I think inevitably it is going to raise costs for those that are producing products out of China, importing products from China. And you will see some price increases as a result, just like we did in 2018.
Well, along with those costs, you have seen just some strikes, some labor discontent over this holiday season. Starbucks and Amazon, not countrywide, again, and just in some specific instances, you have seen strikes ongoing. Are wages also going to be a stress for these companies? Is this sort of discontent among the workers likely to get more widespread in the coming year?
Well, it's hard to say exactly. I mean, I think we have seen, at least in retail, some moderation of the wage increase that we saw since COVID. So you're still seeing wages increase for sure, but it's increasing at a more normalized rate, I would say, between 2 and 4%, versus what we've actually seen the last few years where wages were increasing a little bit faster than that. And I think if inflation is dissipating, there could be, a less pressure that wages would have to increase more because wages right now are increasing faster than prices. And so our modeling in most of our retail models are anticipating wage increases at a more normalized rate around 3%.
Ahead of that, though, there's a very specific deadline that they're going to have to contend with, and that is the deadline for the dock workers to reach an agreement, the longshoremen and the companies that own it. What do inventories look like ahead of that? Have some of these companies been trying to front run any possible disruption?
Yes. So we do believe some of the companies have tried to front run the disruption. We did see that with the threat of the strike a couple of months ago as well, where some companies brought in inventory earlier, just in case the strike was prolonged. You've also seen divergence of containers to go to other ports, changes like that, as well as bringing in that inventory earlier. But inventory levels overall, honestly, if you were to look at what everyone reported at the end of their third quarter, didn't look highly elevated to us. Inventory growth is still in line or slightly below sales growth.
Hey, Kate, just to wrap things up, just quickly here, less than a minute. We saw goods be popular during COVID. That's gone to services. Do you expect that to stay the trend, or could we have a rotation back into goods?
We're really thinking we're going to have a rotation back into goods in 2025. That is our call in the hardlines, broadline space for a couple of reasons. One, we just talked about the health of the consumer, which we do think will remain strong in 25, just given the employment backdrop. Two, it has been a couple of years of negative growth in most discretionary categories. Again, consumer electronics, certain apparel categories, certain home goods categories. And so we do think, lapping those easier compares, the pent-up demand will result in more discretionary growth in 2020.
Fair enough. Hey, Kate, gonna have to jump in there. Thank you so much for joining us this morning. Kate McShane of Goldman Sachs. You're watching Bloomberg TV.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to the world of decentralized finance.
massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Good morning. Welcome to Bloomberg Surveillance. I'm Anna Maherdern alongside Danny Berger in London. What you are contending with today is the final Friday of 2024, the awkward moment after Christmas, ahead of New Year. Many people were hoping for a Santa rally, but we have hit pause. We have futures ever so light this morning. S&P 500 futures are down nearly, there they are, 0.4%. This comes after a muted session yesterday. Danny, though, 2024 has been a stunning year for this equity market, especially in the tech space.
Yeah, so many people got it wrong. So many people heading into 2024 said, oh, it was going to be small caps that take it away. There's going to be a broadening rally. There's going to be a recession. Risk isn't going to do as well. That is not at all what happened. We get some of those calls coming into 2025 that there will be broadening, that it won't just be tech, that small caps will do well. Well, guess what's happened over the past couple months since the election? The Russell 2000 is flat, and it has been tech that has led the way.
And when it comes to what's going on in the bond space, though, even though we have seen rising yields, as Dan Greenhouse has been talking about, the equity market has been able to deal with rising yields. You have a 10-year now just below 4.6%. We are hovering. We were higher than that across the yield space yesterday and today. Danny, you've been talking about that demand we saw in the 7-year notes yesterday. I keep going back to the risks for next year. Risk to global markets in 2025 from Torsten Slok. Number 8 on his list, U.S. 10-year interest rates move above 5% mid-year. 40% are putting a probability on that.
Yeah, well, he also sees the potential for hikes next year. Right. And look, you could look at the setup and maybe scratch your head as to why we're not seeing more of a bid into this bond market. A good auction yesterday for duration, not to mention labor market data that wasn't the strongest, continuous claims rising to the most in 3 years. You could make the argument that there's some labor market weakness that regardless of where inflation goes, that will force the Fed's hand to cut. The fact that we're not getting it, Anne-Marie, to your point, just speaks to the term premium that's being built in. That speaks to the concern not just about inflation, but of higher deficits and what that means in terms of how much yield that investors are going to demand in 2025 on the long end of this curve.
Higher deficits and potentially tariffs, and what this means in terms of a reinflationary environment. Number 1 on Torsten's list, tariffs coming. 90% of individuals expect that. Well, I think they should. President of the United States-elect Donald Trump is already trying to negotiate them. And what we are seeing across in the FX space, Danny, euro dollar, a little bit of strength on euro, but really when you look at the entire year, the story has been weak euro, weak European Union, no growth in Europe, political paralysis in Germany and France, and just U.S. exceptionalism.
Going to say so much about the weak euro story has been about the strength of the dollar. That problem's abroad, that problem's politically in Germany, in France, South Korea, Romania, you name it. Problems abroad make the dollar more attractive. The difference this time around, though, is that Europe would probably welcome a weaker euro. They need it for their growth picture. The S&P cutting 50 basis points, a surprise cut to that extent, because they were concerned about the strength of the franc. How much of 2025 2025 is going to be about central banks playing defense. They're going to be trying to move their currencies in a way to stimulate growth, because when it comes to fiscal governments, Anne-Marie, they don't have the cohesion in order to combat some of the things that might be coming from the U.S., like tariffs.
Right, and the U.S. dollar on track for the best year since 2015. I think that's my chart of the year. All right, we're 1 hour away from the cash open. Here's your morning movers with Yahira Hackes. Hey, Yahira, what do you got for us?
Hi, Anne-Marie. We start with EV battery maker SES AI getting quite the boost in the pre-market, up more than 70%. But since Monday, this stock is up some 500%. And while I can't find any real catalyst for this move, this is a company that could benefit in the future from the transition to EV. Still, the stock is down some 80% from its high reached back, all-time high reached back in November 2021. Next up, we have Tesla. Those shares are down some about 0.8%, and it continues its fall from yesterday. And there was a report yesterday from Hertz basically saying that the car rental company is so desperate to shed its Tesla inventory that it's telling customers if they want to keep their rentals. Or this could be a classic case of profit taking, with the stock up about 80% year to date. And finally, we have Apple. We are on watch for Apple to hit the $4 trillion market cap milestone. The stock is down just slightly, but the number to watch out for to hit that huge milestone is around $264. And Anne-Marie, you had that great conversation with Dan Ives earlier today, and he says that the rest of the street is underestimating Apple's AI potential and its ability to sell iPhones because of it. But at the same time, you have strategists over at BTIG warning that history suggests near-term weakness for the stock. So we'll see if today is the day that it hits that milestone.
Yeah, thank you so much.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea,
upgrade cycle. Turning now to the Fed, markets expecting fewer rate cuts next year, with questions about the impacts of President-elect Donald Trump's policies. Joanne Bianco of Bond Blocks writes, quote, "We do not see much data to justify further rate cuts in an environment of strong growth and sticky inflation, especially if the potentially expansionary policies of the new administration are factored in. Nonetheless, while the stronger economy may mean rates stay higher for longer, this would also be supportive of many areas of fixed income." Joanne joins us now. Joanne, you know, one thing I wanted to ask.
Let's dive right in today and look at the euro.
Okay.
Seems to be having a little bit of a tough time against the dollar lately. Yeah. The euro about to totally tank.
Well, let's see.
What do you think?
We'll break down the recent trends and all the expert opinions
Right.
and give you an idea of what to watch for as we head into the new year.
Exactly.
So to set the scene, it's important to understand, you know, why the euro is struggling.
Right.
We saw those comments from ECB President Christine Lagarde to the Financial Times.
Right.
And she seems to be pretty confident that inflation in the eurozone is under control.
Yeah, she even said they're close to hitting that 2% inflation target sustainably.
Right.
But that's where things get interesting, because the Federal Reserve over in the U.S. sending a totally different message.
Yeah, completely different.
Hinting at fewer interest rate cuts in 2025 because the U.S. economy seems to be rebounding.
Yeah.
So is it possible that we're looking at two economies going in totally opposite directions?
It certainly seems that way.
Yeah.
And that divergence in their outlooks.
Right.
That's a major factor influencing the exchange rate right now.
Now, everybody's talking about this 1.0344 support level.
Right.
What's so important about that number?
Well, you probably already know.
Yeah.
That support levels can sometimes signal a potential turning point in the market.
Mm-hmm.
This level is particularly important right now.
Okay.
Because of where it falls on the chart in relation to, you know, recent price action.
Okay.
And if the euro breaks below 1.0344, it could really gain momentum to the downside.
Oh.
Especially with the holidays coming up.
Because thinner trading volumes around the holidays.
Exactly.
Can exaggerate those moves.
Yeah, okay. That's it.
So opportunity for some and maybe a little bit of anxiety for others.
Yeah, exactly.
Now every deep dive needs to hear from some experts.
Of course.
Derek Halpenny from MUFG Bank.
Okay.
He's predicting the euro will weaken even further early next year, possibly even reaching parity with the dollar.
Wow.
pretty bold statement.
That is a bold statement.
But he does think it'll recover later in 2025.
Okay.
Interestingly, his prediction isn't just based on like the economic picture right now.
Right.
He's factoring in potential political shifts within the Eurozone.
I see.
Particularly in Germany.
Interesting.
So he's looking beyond just the pure economic data.
Yeah, he's taking a broader view.
Okay, that's interesting.
Yeah.
But on the other side of the coin, we've got Bob Savage from BNY Mellon.
Right.
He's putting his money on the US dollar and predicting it will continue to be strong well into 2025.
Okay.
What's making him so optimistic?
Well, there are two main drivers.
Okay.
The first is he believes the upcoming U.S. election is going to create some uncertainty.
Oh, yeah.
And that will lead investors to want the perceived safety of the U.S. dollar.
Yeah, that classic flight to safety.
Exactly.
But is that really going to be enough to keep the dollar strong for that long?
Well, that's where his second driver comes in.
Okay.
The Fed's stance on interest rates.
Right.
Remember, they've signaled fewer cuts in 2025.
Yeah.
And Savage believes this will make the U.S. dollar even more attractive to foreign investors seeking higher returns.
Right. So two very different outlooks.
Yeah.
Halpenny is banking on political shifts and an eventual like economic convergence, while Savage is all about U.S. economic strength and the allure of higher interest rates.
Right.
Makes you wonder, are there any other factors that could really disrupt these predictions?
Yeah, like hidden factors.
Yeah, something maybe that neither of them are considering.
That's the million-dollar question, isn't it?
Yeah, it is.
And it leads us to that fascinating data point that came out last Friday.
You mean the U.S. core PCE inflation data for November?
Yes.
The one that came in below expectations.
Yes.
And caused a temporary dip in the dollar.
Right. It was a small dip. But it did make people pause.
Yeah. Yeah.
Suggest that inflation might be cooling faster than the Fed anticipated.
And if that continues, wouldn't that weaken Savage's argument that the Fed will keep interest rates higher for longer?
Potentially, yes.
Yeah.
It reminds us that these forecasts are based on a snapshot in time.
Right.
Things change quickly, and unexpected data can really shift the entire narrative.
This is why I love doing these deep dives.
Me too.
It's like solving a puzzle with new pieces emerging all the time.
Absolutely. It keeps things interesting.
Yeah, it does. Okay, so we've got these two very different outlooks.
Yeah.
Halpenny sees the euro weakening further, even reaching parity with the dollar before a potential recovery later down the line. But Savage, he's firmly in the dollar's corner, predicting continued strength well into 2025.
Yeah, it's interesting, isn't it?
Yeah.
Because they're basing their predictions on very different factors.
It is.
Halpenny's really emphasizing this political uncertainty within the Eurozone. He thinks it's creating a level of risk that's being priced into the euro.
Right.
And he points to recent elections in Germany and Italy as evidence of this kind of growing instability.
And wouldn't that instability make the euro less attractive to investors?
Exactly.
Especially compared to the stability of the U.S.
Yeah, that's his argument.
Okay.
He thinks that it's just going to make investors kind of shy away a little bit.
Okay, so that's an interesting perspective.
Yeah.
What about Savage's take on the dollar? He's pretty bullish, isn't he?
He is, yeah, and he's not alone.
Yeah.
A lot of analysts see the U.S. as this safe haven.
Right.
In a world that seems increasingly unpredictable.
Yeah.
His argument is that this perception of stability in the U.S., combined with higher interest rates, is going to keep drawing in foreign investment, boosting the dollar.
But couldn't that backfire, though?
Potentially.
What if all this investment creates some kind of bubble in the U.S. market?
Yeah, that's always a risk.
And then eventually weakens the dollar.
It is a risk, and it's something Savage acknowledges.
Okay.
But he thinks the Fed is aware of this and will take steps to manage it.
Okay.
He points to those statements about being data dependent. They'll adjust their policies based on, the evolving economic landscape.
So a lot of faith in the Fed's ability to kind of steer the ship.
Yeah, there is quite a bit of faith in them at the moment.
Okay, so let's go back to that inflation data we were talking about earlier.
Okay.
That PCE inflation data.
Right.
If inflation is cooling faster than expected, like that data suggested,
yeah,
wouldn't that kind of mess with Savage's prediction?
It could.
Yeah.
If the Fed sees that inflation is under control,
right,
they might be more likely to cut rates sooner
Right.
And that would make the dollar less attractive.
Yeah, less attractive to foreign investors.
Exactly.
And then that would create a window for the euro to regain some ground.
Right.
Especially if Halpenny's right about the Eurozone getting its act together politically.
Exactly. And that just highlights how interconnected everything is. You got politics, economics, these data releases.
It's a lot.
All playing a role.
Yeah.
And that's what makes forecasting so tricky.
Speaking of tricky,
Yeah.
there's one more thing we haven't talked about.
Right.
The black swan events.
Right.
That could just totally upend everything.
Yeah, those global events that nobody sees coming.
Yeah.
Things like geopolitical tensions, natural disasters, or, crazy election results.
Oh, yeah.
They could completely shift sentiment in the markets.
And those are impossible to predict.
Pretty much.
It makes it even tougher on investors and travelers.
It does.
Just trying to make sense of everything.
It really emphasizes the need for diversification and being flexible.
For sure.
Holding all your eggs in one basket with currency can be really risky.
Especially in today's world.
Especially today.
So we've covered a lot of ground here.
Yeah.
Expert opinions, economic indicators, even talked about those black swan events.
The wild cards.
Yeah. But let's bring it all home now.
Okay.
What does all this mean for you listening out there?
Well, let's start with travel.
Okay.
Probably on a lot of people's minds.
Yeah.
Dreaming of that European vacation in early 2025.
Right.
This forecast might make you want to rethink your budget a bit.
Because if the euro drops, like Halpenny says,
Yeah.
your dollars are going to go a lot further.
Exactly.
Talking about big savings on, flights, hotels.
Even souvenirs
Oh, yeah.
could really make a difference.
But timing is everything.
It is.
If you're flexible with your travel dates, it might be worth waiting a little bit.
Yeah. See how things play out.
Right. But there's always a chance the euro could rebound sooner than we think.
That's true.
Oh.
It's a gamble.
It is a bit of a gamble.
Now, what about investments?
Okay.
Anyone out there holding euro-denominated assets?
Right.
This forecast might make you a little nervous.
Understandably.
Yeah.
But it's important not to panic.
Right.
The first step is, assess your whole portfolio.
And your risk tolerance.
How much exposure do you have to the euro?
Exactly. Are you okay with riding out some volatility?
Yeah.
Or do you need to, rebalance things?
Because if you're in it for the long haul,
Right.
a short-term dip might not be a big deal.
Exactly.
But, if you're closer to retirement or you have specific financial goals, you might need to change your strategy.
You might have to.
And diversification is key.
Always.
Don't put all your eggs in one basket, right?
Never a good idea.
Okay, so we've talked travel, we've talked investments, but there's one more thing I think is super important for everyone listening.
What's that?
We keep saying stay informed,
Yeah.
but how do you actually do that
That's a good question.
without it becoming completely overwhelming?
See, it's easy to get lost in all the information out there.
Right.
I think a little effort goes a long way.
Okay.
Start by finding some good sources you trust.
Okay.
There are great websites, blogs, even podcasts that give you updates and analysis on the currency markets.
And those economic calendars
Oh, yeah, those are really helpful.
can really help you stay ahead of things.
Exactly, by keeping an eye on these resources and just getting a basic understanding of how economic indicators affect currencies.
Right.
You can make better decisions.
So as we wrap up this deep dive,
Yeah.
I want to leave everyone with one final thought.
Okay.
We've talked a lot about data expert opinions,
Right.
but there's something else that often gets ignored.
What's that?
Market psychology.
Ah, the human factor.
Exactly.
Fear, greed, speculation,
Yeah.
emotions can really drive the markets in some crazy ways.
A sudden shift in sentiment, maybe from a news headline or something trending on social
It
media.
happens all the time.
Yeah, it can create these self-fulfilling prophecies.
Right. And suddenly currencies are moving in ways that make no sense.
It's a reminder that these markets are complex,
They are.
influenced by so many different factors.
Yeah. Both rational and irrational.
Which I guess is what makes it so interesting.
It does.
It's a constant learning process.
Absolutely.
The more we understand these forces at play, the better we can handle the ups and downs.
Well said.
So stay curious, everyone.
Stay informed.
And don't forget the power of human psychology.
Yeah, it's a powerful force.
And on that note,
Yeah.
that's a wrap for this deep dive.
It is.
Until next time, happy exploring.
In case you missed it, on Bloomberg Open Interest.
11 years ago, I bought a Bitcoin on this set.
It was $800.
Yeah, $800, but I spent
Which
the
is a
Bitcoin
lot,
on beer and groceries and gas and video games.
And
I wish I had
hogs.
kept it. I wish I would buy a Harley today if I had.
Yeah, but you
that
probably
Bitcoin.
wouldn't be a TV anchor, and you probably wouldn't still be on this
True.
set. And what a joy that
I'd
is.
be my feet in the sand and the beer in my hand.
Don't miss the next Open Interest.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern right here on Bloomberg. Context changes everything.
Good morning and welcome to the final Friday of 2024. This is how U.S. futures are shaping up ahead of the trading day. S&P 500 futures are down 0.4%. It's been a stellar run for 2024, but we are not getting that Santa Claus rally at the moment. But if you are on this trading desk, you are seeing a little bit of a pause. And as Danny said earlier, hats off to you for being in the office those awkward days between Christmas and New Year's. Euro dollar this morning touched firmer on the euro, sitting at 104.36. Although many are calling for parity next year, we've seen this absolute strength of the dollar. It's going to be one of the biggest dollar strength years we've seen since 2015. Right now, you have 10-year yield sitting below 4.6%, 4.59%. And New York crude this morning, $70.27. As I've been saying, U.S. futures trading lower, 10-year Treasury yield hovering near a 7-month high in this post-holiday trading. Chuck Lieberman of Advisors Capital Management writing this: the economic environment should be slightly positive for stocks and slightly negative for long-term bonds. Inflation prospects could easily worsen between tariffs and immigration policy, which would freeze monetary policy for some period, but longer-term rates would increase. We're hearing a lot of this, Chuck, and he joins us now. Chuck, thank you for spending your Friday morning with you. Happy holidays and New Year to you. So how are you thinking about the start of 2025, especially when policy, things like tariffs, immigration, are going to be so important to how the bond market trades?
Absolutely right, Anne-Marie, and I agree with you. Happy holidays to you as well. In my judgment, there are things to be nervous about. The possibility of tariffs will obviously increase prices for domestic consumers. That's potentially a really big negative when the Fed is trying very hard to bring inflation back to 2%. We also have concerns about the labor market. Job growth has been pretty good, but if immigration policy changes and President Trump actually removes people from the U.S. who came in illegally, but nonetheless are working, that's going to reduce our labor supply, which will drive up labor costs and also inflation. So there are reasons to be concerned about the prospects for inflation.
When it comes to inflation and tariffs, do you think this is a one-off hit, or could this be more pervasive?
Well, it initially is largely one-off, but it then tends to spread through the system. When you have a single auto contract, for example, that's negotiated between the UAW and the auto companies, it's a one-off thing and it pertains just to that industry. But nonetheless, everyone else is watching, everyone else is looking, and many other workers, labor unions, get ideas that they can also push for 10% increases for 4 years in a row. That's a large increase, and so it does tend to transmit through the system.
So what do you make in terms of Fed policy with this kind of fiscal environment?
Well, I think the Fed wanted to get rates down while they could. And so they sort of rushed. They did 50 and then 25 and then 25. So they reduced rates by a full 100 basis points. But the market is looking at the economy. And the market is seeing that the economy is not weak. If you recall, a year ago, a lot of people were forecasting a recession. Obviously, that didn't happen. In fact, growth is well above potential. And it becomes even further above potential if we have fewer workers because we are getting illegal illegal immigrants to leave the country. So no matter how you slice it, I think we've got inflation risk out there. The economy will probably grow more slowly. If you can't hire, you can't expand the economy as quickly. So we could have a very unusual combination of moderation in growth, yet upward pressure on inflation.
Do you think the Fed at the moment is restrictive?
No. Very simply. What I look at is not overnight money. Because if you look at overnight money relative to inflation, you can make a case that the funds rate is roughly on average where it belongs historically. You have a much, much tougher case when you look at the 10-year. At a 4.60 yield with inflation in the ballpark of, let's say, 2.60, I'm being a little bit generous here, you have the 10-year 200 basis points over inflation. Historically, it's been more like 250. So in my judgment, interest rates are not a bar to investment, to spending, and we see a very strong corporate issuance of debt in the marketplace because corporations see prevailing interest rates as attractive.
So when you put all of this together, potentially inflationary policies, you don't think the Fed is restrictive. Do you think we could see a 2025 when the Fed is actually not just on pause, but maybe raising interest rates?
Yes, but not in the early part of the year. In the early part of the year, the Fed is going to wait to see what happens with policy, with tariffs, with immigration policy. They'll look at the growth rate of the economy, and they will wait. They can afford to wait. There's no reason for them to rush ahead to lower rates anymore, and they have good reason to regret, shall we say, having lowered rates as much as they have. But I expect them to be on pause for a while, and then it depends very much on how things play out.
Chuck, thank you so much for your time this morning. Happy and healthy 2025 to you. Chuck Lieberman of Advisors Capital Management. I know you'll be focused on the policies as we are about what potentially 2025 has in store. This is what you need to focus on when it comes to the rest of the trading day, the final Friday of the year, and also the start of next year. So here we are counting down to the bell. We have Monday, pending home sales. Tuesday, U.S. bond market is going to be closing at 2 p.m. Eastern. Of course, it is New Year's Eve. Wednesday, New Year's Day, so the U.S. markets are closed. And Thursday, first round of U.S. jobless claims of the year. What we also get next week is policymakers coming back to Washington, D.C. A big fight already is going to be on Capitol Hill on whether or not Speaker Mike Johnson can remain intact, the speaker, and hold on to his gavel. On Monday, I will not be here, but Romaine Bostick, Danny Berger will be guiding you through the markets on Monday. It's yet another awkward day between the holidays and the new year, Christmas and New Year. If you know what day it is, and if you are showing up to the office, hats off to you. Max Kettner of HSBC will be joining us, Cameron Dawson of New Edge Wealth, Dina Di Lorenzo of Guggenheim Partners, and Patrick DeHaan of Gas Buddy. All of that is coming up next. That does it for me. There was no Santa Claus rally. Thank you so much for spending your Friday morning with me. And to the Surveillance regular viewers, thank you for welcoming me on the program this year. It's been a fantastic 2024, and see you in 2025. Good morning.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow. I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one. I have no advice then to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
AI, how it has penetrated pretty much all sectors, including music. AI can write music, compose music. How do you see AI changing the landscape in fashion?
Yeah, AI definitely helped. When I did the jewelry, I used the AI, helping me to give some idea, but ultimately, you still have to do a lot of it. They just give you very superficial ideas, but at the end, you still have to customize how to really make it and do that. I do not think that AI and the technology can replace the human mind at this moment.
Are you concerned one day we won't be able to differentiate designs by AI and designs by an actual designer?
I don't know. For me, I feel that, when a designer doing, it's the spirit, it's the heart that the computer don't have.
In case you missed it, on Bloomberg Technology.
I believe that we would love OpenAI models inside of AWS. Absolutely. It's we listen to our customers, and if that's something that customers want, we're absolutely game. Obviously, with a partnership, it takes multiple sources, and there's probably some complexities in there, as you allude to. But I think in the fullness of time, it likely is the case.
Don't miss Bloomberg Technology live every weekday.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City and from London as well. This is a special edition of Bloomberg Markets. Caroline Hyde in London. I'm Paul Sweeney here in New York. We're simulcasting on Bloomberg Radio and television, so that's a cool thing. Good morning, Caroline. Happy day after Boxing Day.
Yeah, whatever that technically is called. Being full, I think, is generally what it's called. Everyone recovering from too much overindulgence here in London. And the market's just feeling pretty sanguine. We're playing a bit of catch-up in European trading, but it looks like it's going to be a bit of a down and out day if you're looking at US futures anyway.
Yeah, absolutely. I love the concept of Boxing Day, by the way. I think we need to bring that over here to the States. Futures, Caroline, as you're mentioning, just a little bit on the light side here, off about 0.4%. The S&P off 28 points. The NASDAQ off about 109 points here. Yields a little bit higher. 10-year Treasury, 4.59%. It seems like a range we're in. WTI crude oil a little bit higher this morning. Again, right around that $70 level. So not a lot of movement there. Again, range bound as one would expect. A little bit of a bump in Bitcoin, up about 0.6%, just north of $96,000. I call that out for Tom Keene here. Let's go to Alex Semenova. She covers all the equities for Bloomberg News. She joins us here in our New York studio. Alex, what are you looking at this morning?
Hey guys, good morning. Well, it's been a pretty uneventful week on Wall Street, but there's one name that you can always count on to make some sort of unexplained moves, and that is GameStop. I'm watching the stock this morning. It's down more than 1% in pre-market trading, but that is after it rose in all but one of the last 8 trading sessions. It had a pretty incredible rally yesterday, up more than 6% after a post on X by Keith Gill, better known as Roaring Kitty. In fact, at one point, trading volume yesterday hit almost 5 times times the 20-day average. After that post on X, GameStop is also among the most mentioned companies today on StockTwits. Nearly 4 years after the meme stock rally in 2021, and the Reddit army is still in full force. Investors still piling into these speculative names for no apparent reason. Moves like this perhaps a sign that policy is not as restrictive as it seems.
Talking of policy, I mean, Asia policy, Japan in particular, seeing the yen go weaker, that's put some wind beneath the sails of Asia trading. But there's news out of Taiwan in particular when it comes to deals that aren't allowed to go ahead. It's affecting a European name, delivery hero, and also a key US name too.
Indeed, Caroline. So I'm also looking at Uber. Not a big move on the stock this morning, but it is in the news. That is, of course, as you mentioned, after a German online food ordering company, Delivery Hero, it was supposed to sell its Taiwan subsidiary to Uber, but that deal got blocked by the government there. Uber had aimed to complete the $950 million deal by the first half of 2025. The acquisition would have been one of Taiwan's largest outside of the chip industry. Delivery Hero, which is based in Berlin, said in a statement on Wednesday that Uber can either appeal this or opt to walk away. Uber said in a statement that it is disappointed by the decision, but it would continue to invest in Taiwan. Caroline.
Alex, I'm not even sure I want to go down this route, but Squid Game, go.
Yeah, this is an interesting story here. Squid Game stocks in South Korea, these are media and film companies in South Korea. They're sharply lower after Netflix debuted Squid Game Season 2, after the franchise did very, very well in 2021. Apparently, the reception was disappointing, hence the downward move in some of these companies. Expectations were incredibly high. Names like Artists United and Dexter Studios saw significant declines in their shares in South Korea today.
The power of Netflix. One thing that Paul Sweeney knows a lot about, having covered all media stocks for a very long time. We'll delve into the world of streaming a little bit later. Alex, always great to have you. Thank you so much. Talking about individual stocks on the move. Let's just go a little bit more broad here, because we want to get into just how this all fits into the macro policy, how we're thinking about policy making amid geopolitical risks that we're all keeping an eye on. I want to get out to Michael Green, of course, who's going to be joining us. We're looking at Chief Investment Strategist over at Simplify Asset Management. Michael, so nice to have you today. Thanks for joining on the post-Boxing Day excitement. Look, what are we setting up for 2025? Is all eyes on regulation or lack thereof coming from the United States, the next administration, or is it still about the Fed?
Well, I think there's a lot of uncertainty about what's happening in 2025, particularly from a policy standpoint. And I think that's carrying through in markets like the Treasuries market in the United States, where we're simply uncertain whether presumed incoming Treasury, the Secretary Scott Bessent, is going to focus on extending out the term, increasing the quantity of issuance of 10-year bonds, for example, relative to the heavy bill issuance that has existed under this last administration under Yellen. That in turn is causing term premium to rise, which is really the compensation that you're receiving for taking risk out over time, basically locking up your capital. That tends to be one of the really critical components in terms of inputs of how we think about risk and how risk is absorbed into markets. The other thing that I would highlight is for all the talk around inflation, et cetera, and the idea that really the key risk to treasuries is inflation, is we're just not really seeing that build into things like inflation swaps or break-evens. What we're seeing much more evidence of is this uncertainty about the issuance schedule and the quantity of issuance that's going to occur at the longer end of the yield curve. That's going to really be the deciding factor in terms of how risk behaves for 2025. If we continue to see that term premium rise, I think it'd be very hard for people to continue to justify allocating into equities when they can receive almost the exact same return in treasuries.
So to that end, I mean, what treasuries at the moment, the 10-year at about a 7-month high when you're looking at the borrowing costs. What then tempts you into an equity market? If you are getting that return on basically risk-free investing, are you going to have to barbell it with some focus on tech, or do you have to go more broad in the equity market that has remained incredibly narrow in terms of investing for 2024?
Well, I think the really key thing that happened in 2024 is a lot of the work that I've emphasized in markets is the impact on market structure of the growth of passive investing. 2024 is really a year in which that came to light. We saw the absolute increase in companies themselves focusing on getting an index inclusion, going so far as to call it out in tweets as a corporate strategy. We've seen enthusiasm for things like MicroStrategy potentially joining the S&P. In addition to joining the NASDAQ 100, there's a huge debate that had existed for a long time about the impact of passive. It really feels like 2024 is the year in which that crossed over to a clear acknowledgement that it is having an impact. And that in turn means you're not really asking anyone what they are doing in terms of allocating to equities, because so much of it is ultimately by default. People have a 401k, they allocate into a target date fund. That target date fund has been pre-selected for them. The target date fund in turn buys equities as long as they're employed. So as we look at 2025, it's going to be a question of the economy, how it continues to develop, the labor market, and whether those flows continue into passive vehicles. I see few reasons to think that they aren't unless the economy turns significantly south, in which case that 10-year inflation-protected bond looks really, really attractive relative to equities. But I just don't think there's as much thought going into this as we'd like to believe.
I know you spend, Michael, time and you focus on sentiment indicators. What are they telling you today?
Well, the sentiment indicators, we're seeing this across the board, right? Ranging from surveys of Vanguard investors in which they're showing higher expected returns to equities. I heard discussion earlier about some of the leading stocks or the most speculative stocks, that this is indicating that rates aren't restrictive. The irony, of course, is when you look at something like MicroStrategy and you look at the funding of the 2x levered MicroStrategy, that funding is occurring at near 10% a month at this point. The idea that risk-free rates have anything to do with this rather than sentiment and enthusiasm and a general belief that things can only go up really strikes me as somewhat silly. We're clearly seeing the restrictiveness of rates in the real economy components, housing sales, the fact that auto sales remain depressed, the fact that many segments of the U.S. society are really struggling, and we see this in consumer sentiment and rising delinquencies and defaults, particularly for young people. This is creating a bifurcated economy that, candidly, I would say contributed to the election of Donald Trump and the general sense of populism in the United States.
All right, so for equity investors in 2025, I mean, it seems to me that I've got a Fed that's going to cut, I don't know, maybe a couple of times, so I can't really hang my hat on that so much. It's really has to be earnings growth. Do you expect earnings to come through this year? Because I think the street's discounting kind of a low to mid-teens kind of earnings growth environment.
Yeah, I think that will ultimately be the question. I think we've seen earnings growth be relatively disappointing, particularly if we isolate out and pull out kind of the AI-sponsored boom in capital spending and growth that has occurred for many of the companies in the S&P 500 at the very top of the range. If we look at the rest of the economy, that earnings growth just really hasn't materialized. And again, looking at rising term premium, rising risk premiums, it becomes increasingly questionable whether that can be delivered in 2025 for the vast majority of stocks. What's going to happen to any one individual company, whether NVIDIA or Apple or Microsoft, I think is really going to be idiosyncratic. If we look across the rest of the range, that earnings growth is going to be just very hard to materialize.
Looking across the range, therefore, is US exceptionalism, which ultimately has been driven by the three stocks plus a smattering of others that you cite in the tech world, does that continue into 2025? Or do you start to get excited about other regions, other areas, other growth?
Again, I think it's really hard to get excited about equities broadly. And the reason why I would emphasize this again is this component of passive. If I look at vehicles like target date funds that typically are allocating to a total market index, what that means is that they are no longer rebalancing into the small caps. They're no longer rebalancing into the rest of the world. And as long as the U.S. economy and flows are being driven in this manner, it ultimately means that there's few checks on the continued runaway exceptionalism within the United States. But if that reverses itself for any reason, again, employment would be one of those, then we're ultimately looking at a situation in which it could flip very quickly, but that's not a bullish outlook for the rest of the world. That's just less bullish for the United States.
Michael, on the fixed income space, I can sit there in a 2-year treasury and get 4.3%. Do I need to be a hero and take some credit risk here?
I got to be honest with you. If I look around the world, and I'll even go so far as to cite the Vanguard strategists and others, what they're telling you is their expectations for the return stream associated with equities is well below 4%. We've heard something similar from Goldman Sachs. Again, if my theories around passive are correct, that doesn't necessarily have to materialize in any one year, but it is really hard to argue that people should be ignoring things like 30-year tips offering yields north of 2.5%, which is an inflation-protected measure. That's why you typically are looking for equities, that combination of inflation protection and potential earnings growth. At least half of that has been taken away and given to you in the form of a tip that now is yielding near the highest levels relative to earnings yield in the United States that we've ever seen. The only exception, again, is that .com period in which the profitability of the S&P 500 is so much lower.
Michael Green, great stuff. Thanks so much for joining us. Michael Green is Simplify Asset Management. He's a chief investment strategist over there. And Caroline, it feels like, boy, after the 2 years of 20% plus gains we've had in the S&P 500, boy, what can they do in 2025 after that kind of performance, you know?
I know, and will history continue? And ultimately, many feel that after that sort of exceptionalism, that can be offered again in return, but you have to be ready to stomach some pretty serious valuations and start to, or do you go broader and start to get out of the winning trades, the momentum trade, and start to decide that energy, infrastructure, banks is where you're going to go? I'm excited for that conversation with UBS a little bit later.
Very good. Again, futures just a little bit negative here, off about 0.5% across the board. The S&P, the Dow, the NASDAQ futures off about 0.5%. And again, the 2025 story for a lot of investors is going to hinge on earnings growth. Again, the market's discounting about low to mid-teens growth. Pretty high bar if you think about it. Coming up, hedge funds cash in on the Trump trade. We're going to take a look at the biggest drivers of 2024 performance. That's coming up in just a moment. S&P 500 off 31 points, 0.5%. This is Bloomberg Good Morning.
Top names in business are on Bloomberg.
The question is, if you lower taxes and use it to reduce the debt, the question is how stimulative those activities are, and that's where the Treasury Secretary appointee has got to figure it all out, because he's got to call the balls and strikes about how it all fits together. We got to realize that the impact we have if we don't get this debt back in line.
Nobody covers business like Bloomberg. Context changes everything.
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Names that move markets are on Bloomberg.
Our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't done anything, beyond what I've mentioned to improve the fiscal outlook, and I think that's a shame.
Nobody covers business like Bloomberg.
We are all all in on going cross-platform today. Paul Sweeney in New York, myself, Caroline Hyde in London. We are across radio and TV in a simulcast. And we are currently seeing maybe a little bit of cautious going into this day of trade. Thin volumes, of course. We've seen some flows going into European equities, playing a bit of catch-up after their day off yesterday. But US just signaling that we're going to have another down day. And really, Paul, we want to get into some of the biggest themes of 2024. And some would say it was sort of the institutionalization of hedge funds in particular, and the breadth with which they have started to perform, how large the flows that we're starting to see into hedge funds. And well, one key name, of course, is Ken Griffin. He sat down with our own Sonali Basak a little while ago, talking at the Economic Hub of New York, really about, well, the future of multi-strategy hedge funds. Just take a listen.
Multi-strategy hedge fund segment has exploded in growth over the last several years. And like any area of the economy where you have a rapid number of new entrants, you have a rapid increase in competitive dynamics, you tend to have a thinning out at the end of that journey. You tend to see your second-tier firms, your third-tier firms really face difficult times and disappear. And I think that we're in a consolidation phase within the multi-strategy hedge funds. And it's just part of the business cycle. Now, Leah Khan and her colleagues seem to have forgot that consolidation is just part of the business cycle. But one of the ways that America has created so many both domestic and global champions is that when we have two mid-sized businesses, we allow for mergers to happen, for synergies to be captured, and for these businesses to continue to get stronger and more capable. That's a big part, for example, of the productivity story. The productivity story that was just lost on the Biden administration. So I do believe that the multi-strategy area is now in a period of consolidation, and it will consolidate for a period of time, and then we'll probably see growth again down the road.
So speaking of consolidation, one of your very large rivals, there have been a lot of reports out there that they might sell a stake for the first time to BlackRock. This is Millennium that I'm speaking about. And the reason I ask you about this would be the first time in their history, if they do it. And would you do something like that for Citadel? Would you look for a partner or ever sell a stake?
This is an effort to create business headlines on Bloomberg News.
That'd be good headlines.
Yes. So I mean, first of all, you know, Larry Fink is clearly a legend in asset management. I mean, the BlackRock story, $10 trillion plus of AUM, is just an incredible story. And Millennium is probably in assets the largest multi-strategy fund in the world today. So it's a very interesting potential tie-up between those two firms, and I have great respect for both Izzy and for Larry. Izzy and Larry are really leaders in their respective fields. We'll see if the industrial logic comes to bear and a merger actually happens between those firms. At Citadel, you know, the vast majority of the firm, almost all of it, is owned by those of us who are actively engaged in the firm day in and day out. We take great pride in being a private partnership. It has served us well for 30 years. But if you look at Citadel Securities, we did sell a small minority stake to Sequoia, one of the world's leading venture capital firms. And we would be open to the possibility of selling a minority stake in Citadel at some point in the future.
All right, that was Citadel's CEO, Ken Griffin, speaking to Bloomberg's Sonali Basak. Let's continue the conversation on hedge funds. Joining us now is Bloomberg's Nishant Kumar. Nishant, thanks so much for joining us here. How did the hedge funds do in 2024? Because, boy, the S&P 500 did quite well.
Yes, and sometimes people do compare hedge funds with the S&P 500, which is not the right comparison. But if you look at hedge funds and their role in portfolio and this year, this is probably one of their best years in many, many years. As data stand through November, they are on track for the best performance in 4 years. And with some luck, if in December they make another 1 percentage point on an average, 2024 is going to be the best in 11 years. So that's pretty strong performance. And some of the drivers we have seen, like equity strategies have done well. That's the largest strategy where bulk of the money is. Equity quant strategy has done very well, and macro, has boomed. The Trump trades in November first week, they really lifted hedge fund returns. So you had rising stocks, jump in U.S. Treasury yields, a stronger dollar, all combined together to really lift hedge fund returns in November.
And so it felt like multi-strategy was necessary. It wasn't, we're outperforming in particular. Is that boom, this decision to go into the huge multi-strategy offerings of a Ken Griffin, of an Izzy Englander, is that going to continue into 2025? And are we going to see more people wanting to take minority stakes?
And we just heard Ken, he is not quite bullish on the multi-strat world where Citadel leads. But I don't really buy that argument fully. There is a lot of talk of peak multi-strat. If you look at the really three key elements of multi-strat boom, which is performance. So this year they are going to have some of their best performance in many, many years. Some of these large multi-strats who have track record of 3 decades of performing and with very low volatility, they're up between 12 to 20%. So there is performance. If you look at investors' demand, they just can't have enough of multi-strat. In fact, multi-strats, most of the multi-strats are close to new money. They are, in fact, some of them are returning capital to investors. So capacity is becoming a real problem for investors. They want to invest, but they can't find enough funds to invest into. And then if you look at the third element, which is talent part of the industry, like hedge funds are paying huge amounts of money to traders to hire and retain them. So on all these 3 fronts, I think it remains a red hot market.
Nishan, when I left Wall Street at the end of 2004, I looked long and hard at the long-short equity hedge fund business because that's what folks at that time did. And I concluded then the ability to generate superior risk-adjusted returns wasn't there. The game was already played out. I don't know, I'll stand by that conclusion. Yet money still flows into hedge funds, as you were saying, Nishan. Talk to us about where these shops are setting up these days. It used to be Midtown Manhattan and Connecticut, but now I'm hearing about Dubai, Abu Dhabi, other places that are really attracting a lot of funds.
So U.S. remains to be the biggest hub for hedge funds. That hasn't changed at all. But what has really changed is the landscape in UK, London. This is not the best places right now to start a business or to be based. And Hong Kong suffers from similar problems. Singapore has had its own issues. So all these 3 centers, have lost some of their charms, and Abu Dhabi and Dubai have grabbed that opportunity. So every week I meet people who are in the process of moving to either Abu Dhabi or Dubai. You see people like Brevin Howard, Marshall Wace, Millennium opening huge centers, moving a lot of traders. Like we are talking about dozens and dozens of traders moving to Abu Dhabi and Dubai. So they have kind of benefited from this lower interest in other centers. And of course, the low taxes, which was always there, has helped. In a good weather like sunny Middle East always helps. Safety always helps. So yeah, they have been in a position to grab this opportunity that other bigger centers are offering them.
Look, Miami, pretty nice and sunny too, and there's a reason why Ken went there. Very briefly, Nishan, next year, are we going to see more of this sort of institutionalization of this, looking beyond the initial founders?
Definitely. So that's the biggest challenge for the industry. Will some of these large hedge funds, where bulk of the AUM is, where bulk of the P&L is generated, can they remain the same beyond their founders? Most of these hedge funds are into their, they have, had life of like 30 years and 40 years. So this succession planning is a massive, massive issue. The key man risk is a massive issue for investors. And we'll see how, some of these firms, navigate that. And there are some initial successes, like Brevin Howard has moved beyond Alan Howard. And so we'll see.
Okay. Nishan, thank you so much for joining us. Really appreciate your reporting. Nishan Kumar, Bloomberg hedge fund reporter, coming up We're going to take a look at these markets. 2025 outlook. How about it? This is Bloomberg.
There is no backwards in recycling. There is no backwards in treating pollutants in the water. The trends at times of what you talk in the press may be different from one crisis to the next. My job is to go beyond crisis, to anticipate. That's why innovation. We knew we could do recycling of plastics. For years, nobody was really interested in that. And suddenly, it takes off. But we found a solution in the meantime. So in a way, my job as a chief exec is to deal with the short term and to be able to deliver essential services, even in time of crisis, as well as to see the long term and deliver good result, of course, for my shareholders. Because in a way, delivering good results now is a way to afford the future and to afford to innovate and to see the long term as well.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We felt strongly that there has been an opportunity for there to be an experience on mobile that is centered around gamers. Like, we talk a lot about how there's 3 billion gamers in the world. 2 of those billion play on mobile, and half of those actually play on mobile and they play on another device. But there isn't actually a gaming platform and store experience that is centered around players and goes truly across device, where who you are, your library, your identity, your rewards, that travels with you versus being locked to a single ecosystem. And we've recognized that opportunity for a long time, but we wanted to make sure that anything we built was really grounded in people who play those mobile native games and the creators of them. And so being joined with a team that has real deep expertise in mobile was important to us.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, we are moments away from the start of this market here today on this Friday morning. I'm Paul Sweeney in New York City. Caroline Hyde is in London. This is a special edition of Bloomberg Markets on both Bloomberg TV and radio. Quick check of these futures right before we get this market. Boom, there you go. Negative futures here, and kind of a little bit of a wait and see on this market. Going to be a low volume day, likely here week between Christmas and New Year's here. So a little bit of a softer opening as we're seeing from the futures market, Caroline.
Currently have 9 million reasons ringing the bell over at NASDAQ today. Largest volunteer-based food pantry in Long Island City, so a worthy cause during these holiday-light volumes of down 0.6% as we're just talking about. Yields just creeping ever so higher. We're at about a 7-month high on the 10-year yield, and oil just trading up a little bit. But we want to dig into some of the individual movers, and I wonder why we're going to the publisher of Sports Illustrated next, because it has got a tiny market capitalization of just $67 million. But Alex Simonova has the reason as to why we dig into this company in particular, and it's all about the nicey.
Yeah, Caroline, so a tiny market cap, but a really big move on the stock this morning in a quiet trading day. This is the media company that owns a variety of media brands, including The Street and Men's Journal. It was notified by NYSE that its plan to regain compliance with its listing standards had been approved. It's up about 17% right now, quite the move, and shares were up as much as 20% in pre-market trading. There was also news yesterday that the fitness website Men's Fitness had relaunched under this company, and the stock was up 12% yesterday as well. So pretty solid run this week.
The magazine business. Go figure. What else are you looking at?
So also taking a look at none other than GameStop. Shares were lower in pre-market trading today, but it was up all but one of the last 8 trading sessions, and also had a pretty solid move yesterday at more than 5% after a post on X by Keith Gill, who is also better known, of course, as Roaring Kitty. Really interesting to see this name moving nearly 4 years after the meme stock frenzy back in 2021. In fact, at one point yesterday, trading volume on this name hit almost 5 times the 20-day average. It was also the most mentioned company on StockTwits over the last day. And of course, moves like this suggest that investors, are still piling into speculative companies, that policy may not necessarily be restrictive, since we're seeing some such moves on these high flyers.
All right, GameStop, it's got a market cap of $14.7 billion, up 87% year to date.
Incredible.
I don't know. I know a lot of people traffic in this name in the meme stock world. I'm not one of them, but it does get a lot of volume. Alex, thank you so much for joining us. Alex Simonova, she covers all the equity markets for Bloomberg News. Again, S&P 500, if you're just looking at that, 20% plus gains in 2023, 20% plus gains, like 24, 25% gains in 2024. What do you do in 2025? Let's talk to somebody who does this stuff for a living. Katerina Simonetti, she's at Morgan Stanley Private Wealth Management. She's a private wealth advisor over there. Katerina, again, I'd love to hear kind of the conversations you're having with your clients as you close out a pretty successful 2024 and think about next year. How are you talking to your clients these days?
Well, Paul and Caroline, thank you for having me on the show. This is a really important conversation because it's not lost on clients that we've had double-digit returns for 2 years in a row, and it is only reasonable to expect that the returns in 25 are going to be somewhat subdued. So clients are concerned. The questions that we're having about how to capture returns in the portfolios, how to maximize the income in the portfolios, and most importantly, risk management in the upcoming volatility. And to be fair, our expectations for the year are not dim. We think a lot of emphasis is on Fed and inflation and how all the other factors are going to play out. But when it comes to the practical things that we do before the year end, rebalancing the portfolio and achieving maximum portfolio diversification in stocks, bonds, real assets, and private investments is the absolute key.
So, Katerina, again, a lot of folks are saying, boy, can you have a third year of performance in the equity markets? And to the extent you want to be a little bit more cautious, boy, you can look at the fixed income market. How do you think about the fixed income trade? Do I sit there in a 2-year treasury and get, 4.3% from the U.S. government, or do I take some credit risk?
Well, Paul, if we are expecting that Fed is not going to have quite as many rate cuts as originally expected, it's not necessarily the absolutely worst thing in the world for fixed income investors. Number one, we're going to get higher yields of cash for a little bit longer than expected. And two, if we don't think about fixed income as per se a trade, but as a hold and as an asset that delivers that consistent income and risk management, because on the risk-adjusted basis going into 25, we prefer bonds over stocks. We think it's going to generate yield, but quality, very much so within bonds as well as stocks, is going to be the name of the game for 25.
Volatility, because there's so much, lack of clarity as it currently stands. Katerina, just take us through the thought process over at Morgan Stanley Private Wealth more broadly as to whether or not the Fed will cut more than 2 times. What sort of realistic inflationary pressure will we get from the talked about tariffs that are yet to be imposed?
Caroline, where do I start? Uncertainty about the Fed, uncertainty about inflation, uncertainty about the tariffs and immigration, as all these headlines are going to start coming out in early 25. all of this is going to play a role. And so our expectations for the early half of the year come with the expectation of the higher volatility. And last couple of weeks gave us a bit of a taste of what's to come. Now, tell investors not to chase rallies. And this is the other side of this coin, where we have to prepare and stay calm and make sure that we have high quality portfolios, focus on sectors that generate yield, focus on the areas like financials, industrials, materials, and make sure that we take some profits off the table and avoid higher concentrations in the portfolios. We've had some fantastic performance. This is the time to take some gains.
But the problem is you had fantastic performance in 2023. And if you'd had that mindset around an NVIDIA or the Mag 7 then, boy, did you miss that rally of 2024. NVIDIA's up 180%, let's call it, for the year. So how do you talk some of your clients out of that FOMO feeling that a lot are going to be feeling all over again when it comes to quantum and AI?
Caroline, it's only natural to feel this way. And I think that what we have to ask is are the valuations and profit expectations that are on the table, as well as the fact that Fed has a lot of pressure on them, when it comes to inflation in terms of cuts. Are we going to get as many cuts as expected? That is a big question for us and for them. So when investors are looking at their holdings, of course it is natural not to be missing out on the continued growth. So we don't advise selling out of the entire position, but healthy profit taking and diversification into the other areas where the growth of that level didn't occur yet, and where the possibility of future growth are significantly more substantial than they are in technology in some of these areas that achieved remarkable growth in both 24 and 23.
Katerina, how do you talk to your clients about alternative investments? I'm thinking private equity, private credit, hedge funds. Because when I speak to RIAs, I'm really surprised at the high percentages they allocate to alternatives. How do you guys at Morgan Stanley think about it?
Well, in the time where investors are so concerned about the risk and volatility and protecting the values of their portfolio, having the asset class that could hedge risk in the equity side of the equation, it's extremely valuable. Now, it comes with a cost, and that cost is liquidity. So investors that are comfortable with giving up some of the liquidity in their portfolios are perfectly fine using the alternative investments, because it has huge value, with making sure that we achieve consistent risk-adjusted return. But with that, it's just a piece of the puzzle, where fixed income delivers income, equities deliver growth, cash delivers liquidity, and alternative investments are extremely effective in risk management.
We're going to have some changes to the tax policy, it seems like. We'll see how that plays out. Then that kind of goes to the asset class of municipal bonds. I'm a big fan of municipal bonds. A triple tax-free treatment is I think, a good and wonderful thing. How do you guys position municipals in a typical portfolio?
Well, taxes are a major concern, and inflation is a concern as well. But when investors are looking at their portfolios and analyzing the after-tax income and after-tax performance that they're receiving, tax efficiency is something that is a part of every single conversation that we're having with clients. And this is where municipal bonds come into play. Now, with municipal bonds, you have to make sure that the tax equivalent rate of return that we're getting on muni bonds is actually as good or better that return that we can achieve in corporate fixed income, because there are some amazing buying opportunities on that side. But investors certainly like having that tax-free cash flow in their portfolios, especially in retirement.
Taxation clarity is something that perhaps the crypto world is potentially yearning for, gurning for 2025. How have you thought about crypto and that particular area of potential investment, alternative investment for the 2024 into 2025, Katerina?
Well, Caroline, when you think about the development of crypto world, right, turned from something that we don't mention or talk about into something that was, the most exciting part of the portfolios, then the most volatile part of the portfolios. And now we're seeing